There's still this institutional bias in favor of the U.S. equity market going higher.
The bull market still deserves the benefit of the doubt.
We eventually will see AI adoption spread.
It's accelerating, and it's not going to slow down.
This technology is not going to stop, so we have to invest in it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, shooting for the moon. Elon Musk, SpaceX fighting for what's set to be the biggest IPO in history. As Sam Altman's OpenAI is gearing up to do the same in the coming weeks, Nvidia's Jensen Huang is pitching investors on the next phase of growth. Stocks holding steady this morning.
Look, the race for AI is profoundly changing, and we can feel this with respect to just how it's being adopted. We're hearing about NVIDIA's Jensen Huang saying we now have the agentic era of AI. You hear companies talking about where they're deploying staff into AI and where they're trimming elsewhere. And the scope of trying to raise money into this peak frenzy for AI seems to be escalating. The idea that OpenAI could be the biggest IPO in history, more than double what the previous record was, which was Aramco, gives you a sense of the size and scope of the moment.
3x Alibaba as well. Just unbelievable numbers. The tech story's changing. We're going from buybacks to capex, from shrinkage to tons of supply. I just wonder what that means for the investment implications for the next 12 months.
When you're talking about supply, it's yes on the data center side, although there still seems to be demand on that, but there's supply when it comes to just the stocks available, and the fact that suddenly after years of shrinking the stock market, we're suddenly ballooning it with potentially what could be one of the top 15 size companies ever that is coming as an IPO with a sort of unproven track record. Yes, it is a relatively new company, even though people are sort of weaving it into the fabric of their companies. There is so much unknown, including the destination, right? So it just gives you a sense of race to something that you think is going to be great for a valuation that you think is going to be right. There's a lot of uncertainty.
These companies are huge. We've done a lot of work in private markets over the last few years. Looking at the bond market this morning, need to talk about fixed income as well. 2s, 10s and 30s, 2s. Let's talk about the front end of the curve. And the Federal Reserve minutes. I have to say this, a bit of daylight between the minutes and the consensus that the chairman was meant to represent in the news conference.
When I read the minutes, I thought, why didn't they drop the easing bias, given how many people raised concerns about it? What was the argument for keeping the easing bias? Because ultimately, I heard a lot of argumentation about how much this was going to be a higher for longer type of scenario. It would take much longer to get to that 2% goal. Yes, there was some discussion of AI distorting some of the inflationary inputs. Is that enough to offset it? Do you want to just discount that? To me, the idea that many different people wanted to drop the easing bias and that they didn't, is that a hawkish tell or a dovish tell that even amid all of that discussion, they still kept it in there?
I think you know what Jamie Dimon thinks about interest rates based on the comments he offered to our colleagues over in Asia overnight. They could be much higher than they are today. Jamie, of course, is not a rate strategist. He's a risk manager, and that's a risk we've all got to talk about.
Which is why you haven't seen as much buying step in when we breached some of the highest levels going back to 2007. On the 30-year, right now, you do have a little bit of buying. There is a feeling this is a global inflationary push and that there isn't the will at central banks to really push back. There is a really interesting irony here that we're talking about this incredible fundraising round that we're going to be getting from all of these tech companies at the same time that the cost of money is going up. Why is the cost of money going up not an impediment to all of these financing plans? Because right now it doesn't seem to be. It's a dissonance. It's a breakdown of the traditional relationship with respect to rates and financing activity.
Let's turn to equity markets just briefly. Equity futures this morning, stable, just about unchanged. Another price target just dropped into my inbox. 80.20 on the S&P 500. Chris Harvey, CIBC. He's looking for 80.20, 8,020, and saying this, EPS stronger than expected. How many times have we read that line following a price target raise to the S&P 500 in the last 2 months?
It's all about the earnings. When you take a look at just NVIDIA, to give you a sense of how much earnings have increased, they doubled their quarterly sales since the first quarter of 2025, from $40 billion to more than $80 billion. It gives you a sense of how quickly some of these companies are rapidly growing. Even Target, though, outperforming. You're seeing companies, I'm sorry, Tom Keene, adjust and adapt and start to push forward in order to monetize a moment, even if the economy isn't going gangbusters.
Walmart up next, delivering numbers a little bit later this morning. Coming up this hour, we'll catch up with Tchir of Academy as the market gears up for a series of mega IPOs. Vivek Arya of Bank of America on the lukewarm response to Nvidia's blockbuster results. And Vishal Khanduja of Morgan Stanley as Fed officials leave the door open for an interest rate hike. We begin this hour with stocks edging higher as investors digest the latest earnings from Nvidia. And the IPO pipeline is heating up as SpaceX and OpenAI make moves to go public. Tchir of Academy Securities joins us around the table for more. Pete, good morning. Good to see you.
Hey, good morning.
You saw that opening exchange that we just had around these IPOs. The tech investment story has changed. We've gone from buybacks to lots of capex. We're moving away from shrinkage towards maybe tons of supply. What does that mean for the investor in this space?
You know, right now, I think it's all hands on deck. Everyone's growing, everyone's spending the money to do it. And you were asking the question, you know, what's the disconnect? I think right now there is so much money to be made in the AI space that whether it's 4%, 6%, 8% on interest rates is trivial. Same sort of thing, I think we've been talking about this for the last little while, electricity prices, right? You and I are being affected, but the AI data centers, they could care less, right? It's such a trivial input relative to what they're making. So I think it was this tale of two economies. You've got the AI data center growth, it's booming, everyone's trying to get into it, everyone's rushing headlong. You're seeing more and more companies get into it, which is also why I think NVIDIA's earnings aren't as important, because there were so many tells what's going on. But the rest of the economy is kind of languishing, it feels like. The jobs aren't there, and the degree of uncertainty, I think, is hitting spending.
We'll spend some time on that in just a moment. Let's just talk about potential constraints. Lisa gave a nod to them. You mentioned energy. That's been widely discussed. Lisa mentioned capital. What are the prospects of capital constraints, given how much money is being demanded right now, both in fixed income and in equity in the coming year?
So one thing I think we're seeing is a little bit of a shift where people are much more comfortable owning corporate credit than treasuries. And I think treasuries have become a very generic asset. I think that's one reason you see some pressure on treasuries. As far as I can tell, when we're talking to our large asset managers, they're all in on credit. They love credit. It's cheap. You're getting the higher yields from the treasuries, and you've got a compelling story there. And you're even seeing some of this play out in the super sovereign space. And, you know, kind of wonky to even talk about some of the super sovereigns, but they are trading at their closest spreads ever to U.S. treasuries. So you have, I think, this kind of not aversion to U.S. treasuries, but it's just a generic asset, right? If you're in Germany now, buy bunds. If you're in Japan, buy JGBs. So I think treasuries don't have as much interest, but people are piling into credit, and they're looking at these opportunities saying, well, maybe I want to own XYZ's bonds. I'm getting extra 50, 60, 80, 100 bips, and I think the risk is better, and for credit people, it's the only way to play some of these AI stories.
And it seems like right now the bigger risk is inflation rather than any kind of hit to growth. Nobody is pricing in recession. No one's pricing in some sort of serious downturn. Do you agree that credit and equity are better hedges for the inflation risk, and that is where people should be looking?
So I like credit on that perspective. I think it's kind of an interesting place to be. Again, we're not seeing recession, though there is this tale of two economies. Again, I feel like what you're seeing is in the rates market, if you went back 3 months ago, and I thought before the war started, we could cut. And if we cut, even if it was an aggressive cut, we could control the long end of the bond market. Right now, I don't think we can cut without controlling the long end of the bond market. I think if we cut rates right now, we would lose control over the long end of the bond market. So I think we're higher for longer, and that's here. It's across the globe. Defense spending's ramping up everywhere. So I think you've got some pressure there. But again, I still think we're in that 3 to 5% inflation period. You know, there is a lot of excitement. I think the bond market has one more leg to higher yields. Because the one thing people keep arguing to me is, well, we're going to get all this benefit from AI. We're going to get kind of deflationary pressure from AI. That may be true, but I think the next year to 2 years, it's all about the cost of build-out rather than the benefits of AI.
You talk about the tale of two economies and this idea that we could get significantly higher rates as a result of this push higher. I just wonder at what point the stories start to come together. It seems like either there's a bubble in human capital or there's a bubble in the cost that companies are paying for tokens and access to some of these AI models. They are justifying the increased cost by increased productivity and then laying off staff in order to free up the cash. At what point does that become an unsustainable equation?
I think over the next 6 months to a year, people will actually, for the first time, really be able to say, here's what I spent on tokens. Here's what I kind of could have spent on employees, and make that decision. Because until fairly recently, right, it was all kind of, who knows what we're spending. You'll get these kind of deals. So I think this will actually let people to take a closer look, and it will be scary if AI turns out to be much cheaper than people. The problem is, you know, someone's cost is someone else's customer, and I don't know where all that heads. I had to write about UBI or Universal Basic Income 2 weeks ago because it felt like this is a topic that's going to come up. I really kind of hate the concept. But you can clearly see a path where if we are doing these layoffs, and unlike the .com, where I think everyone was excited, there is so much angst around this from a personal level. I don't think we've ever seen anything like this. And we're heading into an election season, and the country's already very divided on many things. AI, electricity generation, these just seem to be massive political risks.
We just skipped to the final chapter of the book. But since we're there, let's flick a few pages over. What's the policy response going to be to all of that, if that is indeed the end destination?
I think you're going to get politicians who are going to fight electricity, who are going to fight data centers because it's populist. You're going to get some who decide to embrace it, and I think you're going to see a shift in where people are moving this country. And I think this is a part of our overall, as we reindustrialize, I think you're going to see the heartland of America do very well. I think you're going to see, between the Appalachians and the Rockies continue to do well. Last year, I think, was the first time in 30 or 40 years that part of the country beat the rest of the country in population growth and GDP growth. I think you're seeing some of the low per capita red states in particular embrace these things. They're like, hey, we want the jobs, we're comfortable, we will deal with the pollution, we will deal with the after effects of some of these. And I think that you're going to see an opportunity to reshape where people live and the demographics in this country. And if anything, on a real estate side of things, I'm very bullish on the Great Lakes region, on the heartlands, the traditional manufacturing, because they have the fresh water. The weather's actually conducive to this. They've got the engineering schools. I think that could be one of the shifts that we see over the next 5 years, is this kind of flood to the coasts and to deep south changes a little bit as people realize, hey, there are places to do this. And if we're going to do industry, we need electricity and we need fresh water. And that's in abundance in some of these regions that people left for dead.
Now we're getting down the rabbit hole. What are you bearish on? You alluded to it. What would you be short in that kind of world?
Right now, I'm very cautious about anything that requires a deep spend from a personal standpoint. I think even the people with jobs are looking carefully at their spending. So I think construction, homes, this affordability is so real. And again, that kind of drives me. I think some of the really expensive places that, grew up very quickly, especially with the, COVID sort of experience, I think I would avoid those areas. I think there's a chance that people decide this was too expensive, I made bad decisions. Where I live, I actually live more in the swamp than on the ocean. And you have some potential for that to...
That felt personal.
Sorry about that. But I think I want to be a little bit bearish there. I think some of the growth areas done, and I get really uncomfortable with where the spending is going to come from. And once again, I'm going to spend this weekend doing something completely boring, but looking through the jobs data.
Sure.
Because so many people are now asking, why is there a disconnect? Why do we see nothing but doom and gloom on jobs, but the last two headline reports from NFP have been really, really strong?
What's your gut tell you?
That I think it's once again very overstated. I think we're, to me, one of the biggest mistakes that the BLS does is this birth-death model, which tries to estimate jobs created by new companies, they continue to look at EIN, or employment identification number applications, to judge that. And I think we live in a world where EIN, kind of like law school applications, go up when people are worried about their jobs. If all of a sudden you're like, well, maybe I'll drive Uber on the side, or I'll do something. There's whole companies now, I can't remember, someone just told me, one of the big fintechs, they have a whole setup. You go click yes, it sets you up in an LLC, it gets you an EIN, you can do all your taxes and get all that. So I think we're once again making this mistake and seeing, people are creating new businesses. I think it's much more, people are so nervous, they're joining the gig economy to supplement their income.
This was a depressing start to the programme, Pete. We
sorry
appreciate
about
it.
that.
Thank you, sir. No, thank you. For the chair.
I do like space.
Securities. It's a lot to think about there, Bramo, on this technology revolution that's taking place in this country and around the world.
Yeah, and the CEOs of companies are taking different approaches. You have the Standard Chartered approach, talking about the low-value human capital, which generated a lot of backlash. Or you could just say, look, you might not like it, but this is the world we live in, and we have to play ball. And so the question is, as a society, how you sort of message this, and how do you create a network so that it doesn't end up with the same kind of outcome as some of the more pernicious sides of globalization?
I'd say if you don't want the backlash, don't do what Standard Chartered did. And based on the reports I've seen from Meta, where basically now they're training the AI on the habits of their own staff to ultimately, possibly, replace them further down the road. I don't think that's the message you want to be sending to the general public right now.
It's a morale killer. It's also a PR killer. At the same time, more companies are doing it because for them to transition to a more AI-based infrastructure, they've got to prepare for it using the data that they're getting from their current employees.
Equity futures this morning just about unchanged on the S&P 500 with an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Good morning, John. President Trump saying the U.S. is in its final stages of the war with Iran. Trump maintaining that the U.S. would resume attacks in the coming days if Iran didn't agree to his terms. Iran's president has insisted the country was not on the brink of giving in. A majority of Federal Reserve officials warning the central bank would likely need to consider raising interest rates if inflation continued to run persistently above their 2% target. In the minutes from the last FOMC meeting, many called for the Fed to drop its easing bias and signal its next move could be a rate hike. And Samsung could distribute a bonus of up to $40 trillion to chip employees this year after the company struck a deal to avert a strike. Employees will receive on average 513 million won, equivalent to $340,000. The bonus program will continue every year for 10 years, as long as certain profit targets are met. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara later this hour. Up next on the program, Wall Street raising the bar for NVIDIA.
The narrative is out there that they're not 90% of the pie anymore, that they have to split this pie with more players. Earnings momentum and the overall AI GP roadmap is not enough of a new narrative for investors to get excited.
That conversation up next with Vivek Arya of Bank of America, live from New York City this morning. Good morning. In the next hour, another read on retail in America, the ultimate read. We'll hear from Walmart at 7 a.m. Eastern Time, around them. We've already heard from Target earlier this week, the best sales growth in 4 or 5 years. TJX raising its sales growth expectations. Carver in the restaurant business raising its annual sales outlook. So far this week, if you're looking for pockets of weakness, I know it's cherry picking season whenever it's earnings season, but I can find you a couple of decent stories so far this week.
And the guidance from a lot of these retail-focused or consumer-focused companies has been that the consumer is still resilient. They're still spending. Do we get the same thing from Walmart? The key tell to me is how much can they raise prices, right? How much are they being driven in terms of any kind of increase in sales from volume, and how much is it being driven by increases in prices that they are able and willing to pass along? And that ultimately might give a sense of how much inflationary pressure there is under this resilience.
Equity futures right now into that, positive by 0.1% on the S&P 500. Decent gains in the last 24 hours, snapping a 3-day losing run on the Nasdaq, going absolutely nowhere. Decent numbers from NVIDIA, but that stock can't catch a bid this morning. Under surveillance this morning, Wall Street raising the bar for NVIDIA.
For the moment, we haven't seen any slowdown yet, but the narrative is out there that they're not 90% of the pie anymore, that they have to split this pie with more players. Earnings momentum and the overall AI GP roadmap is not enough of a new narrative for investors to get excited. Agentic AI definitely has become a key focus.
So here's the latest this morning. NVIDIA shares flat in the pre-market, up just 0.6% after the chipmaker's big earnings beat was met with skepticism from investors. Vivek Arya of Bank of America raising his price target to $350, writing, "We ignore the noise and focus instead on NVIDIA's unique full-stack positioning in the largest and fastest growing tech market of all time." Vivek joins us now for more. Vivek, thank you for making time for us this morning. When you say noise, what are you talking about?
Sure. Good morning, John. So I think there is fundamentals and then there is positioning. When you look at the fundamentals, they are off the charts. But the positioning tends to be rather full because this is the largest company in the S&P 500. But let's talk through the fundamentals first. Results were exceptionally strong. Sales are growing over 80%. I don't know of any other multi-trillion-dollar company that is growing sales, and this is their third straight quarter of acceleration of sales. The sales are very diversified across hyperscalers, across neo-cloud, sovereign, on-premise enterprise, and increasingly the edge AI, the robotics opportunity. Gross margins are holding up extremely well at 75%, despite all this memory price inflation. And then they also raised their dividend by a factor of 25. So now the dividend yield is actually higher than Apple's dividend yield. So I think from a fundamental perspective, NVIDIA is doing everything right. But the positioning aspect is sometimes what weighs on the stock, because 8 out of 10 investors own it and own it in reasonable size. But if you look at the stock itself, it has outperformed the broader S&P 500 over any 6 or 12-month period. So very strong fundamentals, but kind of full positioning. And that's always kind of the tug of war with the stock.
There is an additional risk factor that you acknowledge beyond just positioning and ownership. You say this: that hyperscaler customers have the desire to deploy more custom chips in lieu of expensive and potentially supply-constrained GPUs. You note that, Vivek, as a risk factor. What's the biggest counterpoint to that thesis in this market?
Sure. So if you look at any hyperscaler, they have a mix of workloads, right? There is a lot of internal workloads. So for example, if you're Google, there's a lot of internal workloads that have to support search and YouTube and Maps and other Google properties. But then Google also has a very large and growing public cloud. Same thing with Amazon, same thing with Microsoft. Right? Meta is almost all internal workloads. So usually for internal workloads, what we are seeing the hyperscalers do is use a lot of their internal custom chips. But for a lot of the public workloads where the infrastructure needs to be very flexible, because you just don't know what the customer's requirements are going to be, that is where you tend to use a lot more GPUs from NVIDIA, because it's an exceptionally flexible architecture. It is basically plug and play. So overall, from an industry perspective, NVIDIA is keeping 70 to 80% of the value of this industry. But if you have an industry where you have 500 to 600 billion of sales that can grow over, to $1 trillion of sales, even a 30% of that industry is still a lot of money. So as the size and scope of this industry grows, I think you will see these two phenomena concurrently, where you will see the hyperscalers continue to adopt a lot more of these custom chips for their internal workloads and sometimes for external workloads. But for the most part, we think that the public clouds, neo clouds, sovereign on-premise enterprise will still prefer to use NVIDIA. And that's why we think that even as this industry grows, NVIDIA can keep over 70% of the value of whatever is being deployed in AI infrastructure.
Vivek, do you think that at some point NVIDIA is going to be pressured to lower the cost of some of the infrastructure, of some of the chips, of some of these tokens, et cetera, in order to make them a better value proposition to some of the alternatives you were talking about?
Yeah, I think there is always that pressure because you are dealing with a very sophisticated group of customers, right? They don't care about your brand name per se. They care about price. They care about performance. They care about reliability of supply. They care about the fact that you're not just throwing a chip at them, that you're really, and that's why we always continue to stress full stack. What does full stack mean? It means that you are optimizing your silicon, your hardware, your systems, your power, your software. You have a base of developers. So even though your upfront cost might be higher than using a custom chip, the ease of deploying this is exceptionally strong, right? We saw recently XAI gave some data on how quickly they have been able to install NVIDIA gear. And with every new generation of NVIDIA chips, it is taking them a lesser amount of time to install that. So that's a big advantage. Number two, every new generation of NVIDIA products, you see their content go up by a factor of 50 or 60%. But then you actually see that the performance is going up by a factor of 3 to 10 times. And that is why on a kind of a cost per token basis, we continue to see this deflation. And I think that's what the customers care for. It's ease of deployments, it's reliability of supply, and the fact that the cost per token continues to drop using this infrastructure.
Going forward, what do you think right now we should be looking for in terms of just ongoing adoption with the potential for $4 to $5 trillion of spend every year, which is what Jensen Huang was talking about?
Right. I think there is this race between a lot of the public hyperscalers. And then, there are two very, very important technology companies that are still private, OpenAI and Anthropic. They are essentially in this race with steroids, right? Literally speaking, in that, or figuratively speaking, in that they're really pushing the ecosystem to adopt and build out this intelligence layer as quickly as possible. And they're doing so in the midst of what is a rather supply-constrained industry, right? There is constraint in wafers and substrates and memory and optics and CPUs. So the industry is trying to move extremely quickly in the midst of supply constraints. There is a build out of this global intelligence layer. And I don't think this race is going to stop anytime soon. And this race is not just confined to the US. We think it's a global race. And that's why we think this can continue until the end of this decade at a minimum.
Hey, Vivek, appreciate your time, buddy. It's good to see you. Vivek Arya there of Bank of America, the constructive bullish view on Nvidia this morning. Up next on the program, Amrita Sen of Energy Aspects as the deadlock in the Middle East rolls on. We'll catch up with Annmarie in Washington, D.C. in just a moment. From New York City, you're watching Bloomberg TV. This story from the Journal this hour, some breaking news for you from the Wall Street Journal. The Trump administration awarding $2 billion in grants to 9 quantum computing companies. One of them, this stock right here, IBM. The department has agreed to give IBM $1 billion of the package. That stock is up in the pre-market by close to 9% in early trading.
Yeah, and that $1 billion is half of the total, even though there are considerably numerous names within this. So real question here of exactly how the U.S. is deploying its equity stakes in which companies and how, what they're trying to get in on so that they can ride this wave. It just gives you the sense of the next phase of this. I mean, we've heard about quantum computing being used by places like HSBC. How much is this the next phase of the agentic adoption?
Looking to build out capacity for the next frontier in this country, in America. That's a single stock story. More of them in just a moment. Let's get to the index level on the S&P 500. Equity futures so far this morning, negative by 1/3%. Another upgrade to the outlook, this time from CIBC and Chris Harvey, looking for 80-20. It's very simple. It's on earnings. And we've seen that repeatedly. Even since the start of this war began. We've seen it repeatedly from Morgan Stanley, from RBC, Denny, from Barclays, and now from CIBC.
Yeah, and frankly, even some of the people who have been bullish are coming out and reiterating the bullish stance. Max Kettner following on just after that, saying they continue to be tactically max overweight equities, even though you see Treasury yields hitting the danger zone. And they explained why the danger zone hasn't been the danger zone and why they can look past it. And the answer? Earnings.
Earnings and rate volatility. I was reading the note in the commercial break, not as high as it was in the last few years.
I mean, to me, that suggests that people are looking for reasons for why this has not been a crimping factor. Other people just point to the fact that the enthusiasm for AI is triumphing over any concern about rates. Nonetheless, the idea that rate volatility and this idea that earnings are coming in strong, people are still feeling really
The
bad.
warm embrace of corporate earnings in America lifting this equity market close to all-time highs. In the bond market, 2s, 10s, 30s look like this. Let's look at the front end of the curve, 4.1%. Now, I'll give you a choice, a decision. Maybe you've got an alternative view on what happened here. But either the chairman did a dreadful job of representing the consensus on the committee in that news conference, or they massaged the minutes to make them sound a little bit more hawkish than the meeting actually was.
That is exactly the right take. You could ask, reading those minutes, given the messaging here, it was ridiculous that they didn't drop the easing bias. Why didn't they drop the easing bias? What was the argument to keep the easing bias, despite all these inflationary pressures and the fact that the majority of the committee seemed to be seeing inflation higher than 2% for a lot longer? That said, I think that your second point is right. How much is this telegraphing that they're not going to be cutting rates anytime soon?
Just getting some other headlines from Reuters just on the Iran situation. Let's turn to crude, Brent and WTI. This from the Supreme Leader, who we've still not heard from directly. Haven't heard his voice at all throughout all of this. Crude is higher by 1.5%. Brent crude up to 106. WTI back through 100. The Supreme Leader issuing a directive on uranium, which of course is a key part of the negotiations with the United States. The Iranian Supreme Leader says the uranium must stay in Iran. Now, that headline alone, and we'll look for further context, but let's just run with that headline alone. With that headline alone, you'd have to say that it would be very, very difficult to come to an agreement with the US based on that statement.
And right now, the fact that you're not seeing oil prices rise more gives you a sense of just how people are not very concerned. I will say what did get people excited yesterday was the fact that 2 super tankers carrying Iraqi oil to China passed through the Strait of Hormuz with the greatest amount of oil to traverse that particular strait going back to the onset of this conflict. They're looking for proof points, not necessarily rhetoric.
So with those headlines, the gains in places like Europe and the equity market flipped to losses, and you're starting to see a pickup in the price of crude. We'll come back to that in just a moment. As we count you down to the opening bell, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with Tesla. Those shares up 1% in the pre-market as the SpaceX IPO filing unleashes fresh excitement around anything having to do with Elon Musk as he prepares to be at the helm of 2 separate trillion-dollar publicly traded companies that could become one. It's something that we've heard before, and it was the subject of a Dan Ives note yesterday saying it's a possibility since Tesla already owns a stake in SpaceX and the two already have joint projects like the Terafab semiconductor facility. Speaking of semiconductors, we are seeing shares of NVIDIA. They have flipped positive, up just about 0.3%, even after it posted a beat and a raise. The sign investors may have simply gotten used to this company posting massive beats. And remember, the stock had already run up about 10% in the past month, as we saw all of its customers post stunning earnings, stunning CapEx numbers. So this may be a story of the good news already being priced in. And we end on another stock, Intuit. Shares are plunging nearly 14%. It also posted a beat and a raise, but investors are focused on its on weaker results in its TurboTax business and its plans that it's going to cut roughly a fifth of its workforce. And those developments are just adding to growing concerns in the software industry that if AI can increasingly handle things like tax prep on its own, what does it mean for these companies that are built around that work? John.
Yahara, thank you. Thank you for the update. More from Yahara later this hour. On our radar this morning, NVIDIA shares holding steady after robust first quarter earnings and higher rewards for investors. Wall Street setting a high bar for the chip maker, questioning the growth story in the competitive AI market. Elsewhere, SpaceX filing for what stands to be the largest IPO in history with a $75 billion funding target. The company revealing billions in losses, along with a plan to give Elon Musk near total control over the company and up to 1 billion shares. And finally, OpenAI gearing up to file a confidential IPO as soon as tomorrow. People familiar with the matter telling Bloomberg the company is looking to debut sometime this fall. Goldman and Morgan Stanley working on the filing in the race to get ahead of rival Anthropic.
So they're trying to ride the enthusiasm from Cerberus and get ahead of Anthropic at a time when people have been skeptical about some of its valuations. Nonetheless, they want to come as the largest IPO in history. I really can't stress enough how much of a divergence you're seeing in terms of total value. I think they're going to raise $60 billion. That's the estimate. And it's less than $30 billion for the second biggest, what would be. Now, what was the largest, the Aramco initial public offering. Massive scope and scale for an industry at the heart of this race for AI.
All of these intriguing side stories with the personalities as well.
Yes.
Altman, Amode, also Altman and Musk. It's quite a big race for the year ahead.
Yeah, Altman versus the world.
Right, seemingly.
And a lot of people have kind of soured on the story of Sam Altman. How much does that play into the appetite? So far, it doesn't seem like that much, given the fact in their recent round of funding, it was some north of $800 billion, their valuation. So this could be a $1 trillion IPO.
Let's get you that breaking news in the energy market. Crude moving higher as the Iranian supreme leader says the uranium must stay in Iran, according to Reuters reporting just moments ago. President Donald Trump insisting a peace deal with Tehran is still in its final stages.
If we don't get the right answers, it goes very quickly. It would have to be a complete 100% good answers. And if we do, we save a lot of time, energy, and lives, most importantly. It could go very quickly. Or a few days. It could be a few days. I'm not doing any relief until they sign an agreement.
Tehran reportedly assessing the latest U.S. proposal to reopen the Strait of Hormuz. Annmarie joins us now from Washington for more. Annmarie, that breaking news moments ago turned around this market. Equities lower, crude turning a little bit higher. What do you make of that report from Reuters?
Yeah, crude turning higher, Jonathan, because the Israelis have made it very clear in order for them to view that this war is over, the highly enriched uranium that Iran has needs to be gone or be taken out of the country and put into a third party, or the United States needs to deal with it. So I'm guessing the market is just viewing this as a negative towards any time soon that we can get a deal between Tehran and Washington. And we can bring in Amrita Sen now of Energy Aspects for a little more insight on this. Amrita, as Jonathan said, the market turned around on this report from Reuters that the Supreme Leader has issued a directive that the country's near weapons-grade uranium should not be sent abroad. Does the market now start to view that potentially the president's going to have to go back to strikes?
Well, I think the market isn't pricing that fully in yet, right? It's not full escalation. But what I would say is that, look, we've been very skeptical. Each time there are these headlines from Pakistan, from the U.S. administration, or we're near. We've been talking about being near to a deal for several weeks, even months now. The market tends to sell off faster, partly because Brent positioning is still long. But in reality, neither side is willing to make any significant concession. And I think this is exactly proof of that, what Iran's Supreme Leader has said. And it does suggest, at least from the interpretation the market's going to probably come up with, is that no, a deal isn't near anytime soon, which is why prices came off last evening.
So it's basically living in, as one guest told us yesterday, continuous purgatory. Why then are prices still capped at this level, around 100 for WTI and 110 for Brent?
Look, that's a great question and something we do a lot of analysis on internally as well, because you would think, given the scale of the supply losses, we should be potentially even double, right? What we are seeing is record levels of destocking. We did some analysis on this. We did start the conflict with about close to 400 million barrels of excess inventory. And so we've run down, call it almost like half of it. But then we've also been drawing down SPR at record levels, right? So what we are seeing is that the market's in a massive deficit, but we really haven't gone into outright shortages yet. We calculate that's about a month and a half away, so it gives us till end June. But what I worry about is that everyone, right, and I've been on the road for a couple of weeks now, everyone's hopeful that, okay, the straits are going to reopen end of June. First it was end of May, then it's now end of June. And we are really living hand to mouth right now, running down those inventories. End June or comes close to that, refiners around the world, I'm in Asia right now, are extremely underbought. Then when they do come to the market, I think the pickup in prices will be material. And that's when we can get the overshooting to the upside, because there is this sense, complacency is the wrong word, but hope that things start to pick up a little bit and we can just get by just running down inventories, and then restocking is a problem for the future.
So, Amrita, you're saying by the end of June, we're going to hit tank bottoms and we're going to see a risk higher for crude. How much higher?
I don't think we'll hit tank bottoms globally, to be clear, but I think there are definitely parts of the world. I mean, look, China's got stocks for months and months, right? China's not going to have problems, but there are definitely other parts of the world, be it Asia for crude. But look at product stocks in the US. We are very quickly racing towards tank bottoms in parts of the US as well. So yes, there will be pockets where we hit tank bottoms, but when that happens, then physical markets, not financial markets, again, that's a separate story. It's a little bit broken right now. Liquidity is really thin. And again, all the tweets coming out doesn't give markets a lot of confidence to put on positions. But the physical market, you're likely to see prices go up to previous highs. We've seen crude trade at 160, 170, potentially even higher if you are genuinely stocking out in parts of the world.
Amrita, thank you so much for that. Amrita Sen of Energy Aspects. And Jonathan, as Amrita's on the road, what she's hearing is that those inventories, we are now half being drawn down. Everyone is going to have, when they look at their calendar, June, which is why a lot of people think something has to happen before then. Potentially, this means this White House or the regime blinks.
Annmarie, thank you. The status quo is unsustainable. We've heard it repeatedly in the last 24 hours. AMH down in Washington, D.C. If you're just joining us, that breaking news from Reuters in the last 20 minutes or so, citing two senior sources out of Iran on the supreme leader in Iran who would like to keep the uranium in Iran, which could be a sticking point in the negotiations with the United States. Negotiations that the president says are in the final stages.
President Trump has said it's non-negotiable for Iran to have nuclear weapons. That's been one of his North Stars through this entire conflict. At the same time, if they're close to an agreement, how is this compatible with it? Right now, the market's getting a bit jittery. At the same time, not taking this seriously, that it actually is a breakdown in talks. So it gives you a sense there is a benumbing of markets after so much back and forth of headline risk over the past couple of months.
WTI triple digits, $100 a barrel. Brent crude this morning just around 107. With an update on stories worldwide with your Bloomberg Brief, back with us, Yahara has more. Hey, Yahara.
Hi, John. The Trump administration taking stake in select quantum computing firms. The Wall Street Journal reporting the White House is also awarding $2 billion in grants for 9 companies, including IBM. That's why those shares are up 6.7%. The funding is set to come from the Biden-era CHIPS and Sciences Act. AI giant Anthropic is on pace for its first profitable quarter. The company is seeing a surge in revenue driven by demand for its AI software. The cloud maker expects to post nearly $11 billion in revenue for the second quarter, more than doubling from the prior 3-month period. And Standard Chartered CEO Bill Winter's remarks on, quote, lower value human capital are sparking questions. Sources telling us here at Bloomberg, regulators in Hong Kong and Singapore have pressed the bank about the impact of job cuts in their respective markets. That's your Bloomberg Brief. John.
Pretty controversial comments from earlier this week. Yahara, thank you. Up next on the programme, preparing for higher rates.
You have bond rates going up. Inflation is a little bit higher than people thought. But I'm not surprised. The notion that somehow people said they'll never go up is the wrong notion. They could be much higher than they are today.
Up next on the programme, we'll catch up with Vishal Khanduja of Morgan Stanley, live from New York City. You're watching Bloomberg TV. Equities pulling back just moments ago, down by 0.4% on the S&P, negative by 0.5 on the Nasdaq. The why? I'm sure you're very bored of this, but this is the why. It's in the energy market. It's crude, just inflecting a little bit higher. Brent crude to 107, up 2%. Likewise on WTI, we got these headlines from Reuters, citing two senior sources out of Iran, that the supreme leader has issued a directive on uranium, that the uranium must stay in the country. As we've said repeatedly, that could be a sticking point, will likely be a sticking point in negotiations with the United States. So you see that move in crude, you see this move in the bond market. 2s, 10s, 30s, yields start to climb on a 10-year right now, higher by 3 basis points, getting back to the 460s.
Yeah, the computers don't like this because those are the people who are left trading on any of these headlines. And ultimately, the inputs still matter. The takeaway for me is this still is a conflict that does ultimately matter, even though everybody has tried to move on. And even though people are trying to glean comfort that there are going to be talks, there still are quite a few sticking points.
Matters to energy, matters to the bond market. Under surveillance this morning, preparing for higher rates.
You have bond rates going up. Inflation is a little bit higher than people thought. But I'm not surprised. The notion that somehow people said they'll never go up is the wrong notion. And so companies like us prepare for higher rates, lower rates, and figure those things can happen. They could be much higher than they are today.
So here's the latest this morning. Wall Street preparing for a world with higher interest rates. JPMorgan CEO Jamie Dimon warning global bond yields could continue to climb from levels not seen since the global financial crisis. Vishal Khanduja of Morgan Stanley writing US yields are showing clear signs of forced selling by investors whose portfolios are extending in duration. Vishal joins us now for more. Vishal, good morning. Good to see you, sir.
Great seeing you.
Is the selling over?
We felt it a little bit on Friday and Tuesday, the forced selling part of it. I think the first two big rafts of selling that went through were actually not technical or forced. It was just a massive macro shift going through. You're going through the war, which is still right front and center, the reason for all of this. And then I think the expectations, and we were included in it, was of growth and demand destruction, a little bit coming from higher oil prices that never manifested. At least even if you squinted, you couldn't see it in the data. And then the earnings took over from that bit. So the last bit has come only from real yields, not from break-evens widening. And then Friday and Tuesday price action was very clear-cut convexity selling that was going through.
Where do you think the ceiling is now for interest rates? When does the buying start to come in?
So we've started to see buyers come in, but I think there are those three clear conditions. Like the reasons for all of this need to be solved first. Clear-cut clarity from the conflict ending. Cannot be another Axios headline, cannot be another Reuters headline, at least for the negative. If we are going and having a conflict or full-blown military action over the weekend, we're going to see significant flattening and another hike being priced in very easily by the time we come back from the long weekend. But we are starting to see some of that sort of bond math kicking in. Now you need about 250 odd basis points of a sell-off in the 2-year for you to make a negative return if you buy a 2-year treasury today. So that bond math is kicking in. Very different than 2022. When you went in, I think December 21, 2-year was at 78 basis points. So even a 100 bip sell-off got you negative, and that's what 2022 was, but 10, 15% negative returns. We're not seeing that, and that's why you're starting to see the nibbling coming back into the bond market.
Can you explain the bond math behind the investment-grade bond market right now? Because we're seeing people hide out in investment-grade to avoid the duration risk that you're seeing in treasuries, even though the duration risk is picking up in investment-grade, and it's tied to the tech story in terms of all of the issuance. Does it make sense that that's a haven right now?
Not to us, actually, meaning the moment it gets into that lower 70 to 80 basis points over treasuries, with the makeup of that index being less tech. Again, coming into this year, tech was not even the top 3 to 4 sort of allocation of sectors within the index. Now going forward, probably in the next 6 months, I think we were discussing this in the last couple of months here in this show, where a lot of these bonds are getting issued with looser language in terms of who's going to be on the hook at the end of it if this does not work out, or if it does not work out with the same sort of exuberance that we are going into this. These bonds are going to have massive amount of spread duration because they are for longer term projects, and the negative convexity that they hold on to. Some of these bonds are issued in a way where it has a 3-year callability and a 14-year extension time period. So the negative convexity one-on-one kicks in. So we don't think that these are as easy of structures to get into, and the compensation that we are getting is not commensurate to the risk that we are taking on.
You are seeing spreads start to widen out, just to touch on some of the tech debt that's been issued. At what point, though, do investors really push back and say, hold on, guys, if you're going to make us take on 15-year debt tied to a data project that hasn't been built yet, hasn't been proven out, and has depreciating assets that rapidly have a 3 to 5 year cycle, we're not going to lend you money so easily. Why aren't we seeing more of that?
I think active managers have started to push back. So I think what you're seeing now from issuers, they're trying to target the high yield market where the covenants are stronger. Then another step higher is the securitized market. Covenants are extremely stronger there, but you cannot issue 40 billion of debt at 40-year there because the average life of covenants actually reduces the amount of risk that the investors are taking. So I think issuers are starting to see that. They're starting to go into different countries, different jurisdictions, different currencies, and different markets to act.
Spread the love.
A little bit of that, but then the love comes at a cost, and then like it does, and then the covenants are much, much stronger on that bit. So yes, we're starting to see few of the self-correcting mechanisms come in, but there's a raft of the yield buyer externally, globally sitting, who's buying a lot of this IG debt, and a lot of, unfortunately, is getting bought by the passive side of things. And they don't actually look for what the structures are. If it is IG, it is going into the benchmark, and they're buying it.
Listening to this conversation, we started with treasuries, we finished with credit, but I'm hearing the same thing, crowding out additional supply. Is that becoming a problem? And who is it a bigger problem for? Corporate America or the sovereign for treasuries?
Absolutely for treasuries for now. Again, if you think about it, take a huge step back, there are 3 big balance sheets as fixed income investors that we invest in. It's government, which could be sovereign, municipalities, etc. It's corporate and securitized. COVID happens, government spends about 10 trillion, makes sure that the corporate and consumers are not going down, and they balloon up their fiscal issue. That's why we are asking for more term premium. We're baffled. 530 still is at 85 basis points on that bit. But the corporate and consumer balance sheets, there are sections that are deteriorating, are peaking in their credit quality from a fundamental perspective, in the perspective of being able to service their debt, being able to service their coupon and payback par. Now, in the last 6 months, now you're getting into areas where the speculation increases and the debt metrics are reducing. So almost like 2003 to 2005. Debt metrics peaked there, and then you started to see a little bit of that deterioration.
So this is the era of leverage that we're entering. We're in right now.
Absolutely feels like it, but the earnings for now are backing it up. So the debt metrics are still okay, but then the moment of whiff of earning release comes off. And that as debt holders, all we are worried about right now, you're sitting on so much cash, you're not finding great projects or great M&A activity because every multiple is extremely high in your area, you're going to buy back extremely high. So I think that's, as a debt holder from the IG perspective, going back to your point, not a good feeling.
Vishal, this was a clinic. We appreciate it. Thank you, sir. Vishal Khanduja there of Morgan Stanley, and some worrying takes on what's developing. There's some runway here, but you've got to focus on what's developing.
Essentially, bond investors need their money back. And at a certain point, if we're talking 15 years tied to a data center with not a lot of covenants, it starts to get a little bit more worrying. 2003 to 2005 build-out, not exciting.
No, not great. No. Coming up next on the programme, David Lebovitz of JPMorgan Asset Management, Marc, the former Chief of Staff to the former VP Pence, BNY CFO Dermot McDonogh, and Sam Lynton-Brown of BNP Paribas from New York City. The second hour of Bloomberg Surveillance just around the corner.
The rest of 2026, I think the Fed sits squarely on the sidelines.
To get any cuts at all, it does have to start with the labor market.
Maybe, possibly, there's an opening by year end.
Well, the majority of the FOMC is going to keep their heads down.
Does inflation actually cause weakness in the consumer? Then you get maybe an opportunity for Warsh to act.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. Negative 0.4 on the S&P, down by 0.5 on the Nasdaq, down by 0.75% for the small caps. With this move in the bond market, 2s, 10s, 30s, yields higher again on 10s by 3 basis points and back through 460. Off the back of this in the energy market, energy higher by 3% on WTI. Brent crude back to about 107. These headlines from Reuters in the last 60 minutes or so, according to two senior sources out of Iran, on the supreme leader issuing a directive on uranium and suggesting the uranium must stay in Iran.
This is the risk case that talks don't go well. And why should they go well, given some of the mixed rhetoric that we've been hearing, which is the reality that markets are waking up to today? It just highlights how people keep trying to ignore this story, and it keeps coming back and rearing its head. The amount of comfort that people got yesterday from a couple of reports about tankers going through the Strait of Hormuz and this discussion around getting better talks gives you a sense of what people want to happen, but not actually what is happening on the ground.
This is why this week was so important from the earnings side of things. From the earnings perspective, we were focused on the retailers. How is corporate America doing? How is the American consumer? This is what we heard from Target, best sales growth in like 5 years. TJX raising its sales growth expectations. In the restaurant business, mentioned Carver because sales are performing there. Cherry picking season, I know, but so far so good on this front. Walmart just dropped. How's Walmart shaping up?
Less good, I would say. You can take a look at earnings per share for the second quarter of 72 to 74 cents. The estimate was 75 cents. They said that their first quarter operating income was negatively affected by 250 basis points on higher fuel. A lot of the other aspects that were really coming in line, revenue coming in higher than expected, comp sales at Sam's Club coming in better than expected. We'll go through all of the numbers. This, though, really does highlight how they are seeing higher expenses and potentially are not able to pass it along fully to all of their customers. You're seeing this as Kroger's came out and said they're cutting their prices to compete more directly with Walmart. And Walmart has said that they are trying to invest in price, not raise prices, and taking it on the margins. Are you seeing that in today's earnings?
Am I getting this right? When Walmart does well, things are bad. And when they do badly, things are bad. Is that how this works?
Well, of course, John, because
okay,
you're talking
good.
to me. But at the same time, I could say that Walmart maybe isn't as much of a cyclical story. Nonetheless, this does show how the biggest companies are getting pressured, especially when they're trying to run clean balance sheets and work on the margins by cutting costs and squeezing some of their suppliers.
So far this year, the stock has been up, doing quite nicely alongside Target. The stock this morning is down by 2% in the pre-market. Lots of tech stories still to come. Coming up this hour, we'll catch up with David Lebovitz of JPMorgan Asset Management as stocks snap a 3-day decline. Marc, the former chief of staff to former VP Pence on diplomacy with Iran, and the BNY CFO, Dermot McDonogh, on increasing AI adoption at one of the best-performing US banks. We begin this hour with stocks lower following a muted reaction to Nvidia earnings. David Lebovitz of JPMorgan Asset Management still bullish, writing bonds won't act as an effective hedge when inflation risk is rising. On the equity side, we continue to see opportunity and remain overweight. David joins us now for more. David, good morning.
Good morning.
How hungry are investors right now for more tech? And how easily will they digest the massive IPOs we're getting in the next 12 months?
So what I would say on the tech front is we still see structural opportunity there, but we also recognize how far things have run over the past couple of months. And, this rebound from the situation in the Middle East that began in March has really been driven by technology at the end of the day. And so while we're conscious of that and we do want to lighten up a little bit on that exposure, we're not running away from the U.S., which is obviously a tech-heavy market. We think that the fundamentals are there, the earnings are there. Even if we're missing expectations, the numbers themselves are still pretty good. You asked the question about the IPOs. We have supply coming, and oftentimes when supply increases, if demand doesn't increase at the same pace, you can see an adjustment in price. Whether or not that has a market level impact, I think is probably to be seen. But the question is, tech has had such a strong run over the past 15 years. Are we reaching the point where you're seeing those animal spirits rear their ugly heads, where you're seeing more speculation in the market? I'm less concerned with how they get taken down. I'm more concerned with what this means for risk taking over the next 12 months.
Let's just stand the story of supply as a force in financial markets and think about it beyond just equity. We're seeing it in fixed income on both the sovereign side and now on credit from the hyperscalers. We just had that conversation. Supply is everywhere right now. These demands for capital are picking up. Do we have the demand on the other side to meet it?
So the question about, and I think the hyperscalers specifically are the issue that's on the market's mind. To us, this is really more of a corporate financing decision more than anything else. Day one of business school, what they teach you is that the capital structure doesn't matter. It's how you use your capital structure that will make or break the project. And so what I think you're seeing from the hyperscaler community is a recognition that they can't just allow all of their cash flow to get eaten up by these projects. They're going to the debt markets where, again, demand has been robust. And I think more than anything, it's really this all-in yield story. I mean, what struck me over the past couple of weeks is how orderly spreads have been against the backdrop where yields have really gapped higher, particularly as of late. And I think what that reflects is if you can get paid 5% on IG paper, if you can get paid 7.25% on high yield, investors are going to take that because the memories of the post-GFC environment where rates were pegged at zero are still fresh. And so yields available and people will take it.
We've been talking about who gets crowded out first, and John has pointed to this in a significant manner. Is it going to be some of this corporate issuance on the stock and on the bond side, or is it going to be governments? A previous guest was saying it was going to be governments in terms of their issuance. Do you agree with that?
I wouldn't disagree with that. I mean, in our client conversations, the thing that's once again been coming up, and it feels like this is somewhat cyclical, but people are increasingly concerned with what's happening with the deficit, what's happening with the debt. This isn't just a U.S. conversation. It's really a global conversation. And I actually had a client the other day say to me, well, is some of this corporate debt, particularly tied to IG tech companies, is that actually a safer bet than what some of the stuff that we can find in the sovereign market? And so, what's interesting about the environment we're in today is you're seeing that tension begin to emerge. I don't want to go as far as to say that the bond vigilantes are back, but I think now that you're seeing the inflation data begin to pick up, that the administration wants to prime the economy in advance of the midterms. That's what I think the bond market is saying, and that's why I think people are now looking to high-quality corporates as a potential substitute if the goal is diversification.
At this point, we've been talking a lot about why haven't higher yields, higher benchmark rates crimped the equity appetite. And Max Kettner used to talk about the danger zone of 4.5% on the 10-year. Came out this morning with a note saying the danger zone hasn't worked because earnings have been so strong, rate volatility hasn't been that great. It's no longer the danger zone. Is there a new danger zone that is a higher threshold?
So I think that 5% is still very much a line in the sand on the 10-year. I think that if you saw yields get to that point, you would definitely see equities get some indigestion. I do give a lot of credence, though, to the idea that the earnings story has helped to offset some of this pressure stemming from higher rates. I also think that markets are still viewing the driver of higher rates here as being temporary, right? What really set this whole thing off was the CPI, but more so the PPI report the other week. The market is saying the left tail risk from the situation in the Middle East has collapsed. The administration wants to do a deal. They're going to get the oil flowing, and everything is going to be okay. That sounds great, but it needs to begin to happen. And, it's not lost on me that gas prices are much higher than they were a year ago. Food prices are much higher than they were a year ago. The lower leg of the K, to your point about Walmart, the lower leg of the K is still struggling here. And so if we can't make progress, we have time as long as asset prices are elevated. But if asset prices begin to correct, then the upper leg of the K comes under pressure. That's where I think you have a real problem.
Lisa's trying to work out where the risk is in financial markets. I'm just listening to the way that you're talking about financial markets, and I've heard this a few times now. The all-in yield is good, right? Spreads are tight. Let's run with that. All-in yield's great, spreads are tight. A growing proportion of the all-in yield is the supposed risk-free rate. So ideally, I would have thought you'd say, look at that, OK, I want to buy the underlying, I want to buy treasuries, I want to buy the risk-free. But you're saying that's where the risk is. And I've heard that a few times. Whenever anyone comes on the fixed income side of things, they'll say, yeah, spreads are tight, but I like the all-in yield. And I'm sitting here thinking, well, if a growing proportion of the all-in yield is the Treasury and it's meant to be risk-free, why wouldn't I just buy the Treasury? Why take the corporate risk?
Because I think that at the end of the day, there's more certainty around the corporate outlook than perhaps there is around the government outlook. And
that's the headline.
To me, that's why I come in every morning and the first thing I look at is move, right? What is interest rate volatility doing? And the gap up we've seen in rate volatility, I do think is tied not only to the inflation story, but some of the rhetoric coming out of Washington. You have that offset, to your point about the equity market, from solid fundamentals. That supports corporate paper, but I think you're going to get bounced around sitting in risk-free paper.
People are more concerned about the sovereign than they are the corporate. That's the headline.
Absolutely. Remember when Microsoft actually traded inside of government debt briefly for a second? Do we start to see that kind of dynamic? If that's the case, though, we always say the crisis always happens in debt perceived as safe. If treasuries are no longer safe, it's not exactly not going to affect all of these other products that potentially have some sort of tie to it. So even if they are safer, it highlights the risk inherent in markets right now.
I think it's a visibility issue more than anything. There was a great report out of one of the regional Fed banks the other day about how the run rate of AI spending has increased across the corporate sector. I mean, it's basically up 50% relative to last year. And so if you're sitting there as an investor saying, okay, well, the money's getting spent, one man's CapEx is another man's revenue, this seems like it still has legs, or you're saying, I'm not really sure what's going to come out of Washington or Brussels next, it's a very different.
Do you think we need to see corrective action from the Treasury? Where does it come from to put a lid on what's developing in this bond market?
So I think a couple of things. One, they can try to talk it back down. But one of our views more structurally over the next 10 to 15 years is that term premia are going to be higher, rate volatility is going to be higher because we're in this environment of fiscal activism and economic nationalism. That's just going to mean that you have more volatility in government bond markets. They can try to talk it down, but what they really need to do is they need to allow the inflation that we're now seeing to run its course, and they need to give the market a better sense of what may be coming from a spending perspective. I think there are still a lot of questions around midterms in the fall. What is the administration going to do to try to prime the pump in advance of that? There just isn't great clarity. And so that's, again, what I think is really impacting the rates market today is just that uncertainty there, which you're not necessarily getting on the corporate side, given that fundamental setup.
Are treasuries a good hedge against the AI hopes and dreams not coming to fruition?
So I think that they are, because our view is that treasuries are not an effective hedge when inflation is the problem, but treasuries, in theory, and we've seen it over the past couple of years, should be a good hedge when growth is the problem. We know the story here about, consumer 70% of the economy, but the cherry on top has been the AI CapEx. If the AI CapEx story begins to falter, you have a weaker consumer, markets are going to get spooked about the outlook for growth. I do think that treasuries act as a hedge in that environment.
David, this was fun. It's good to see you. Thank you, buddy. David Lebovitz there of JPMorgan Asset Management. In the bond market right now, yields higher by about 3 basis points on twos to about 4.1%, tens back around 460. With an update on stories worldwide this morning, with your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Iran's supreme leader ordering that the country's near weapons-grade uranium should not be sent abroad. Reuters reporting that Iran's top officials believe sending the material outside would leave the country more vulnerable to future attacks. Meanwhile, we are seeing Walmart shares sliding nearly 2% in the pre-market, the company posting steady sales gains but flagging higher fuel costs. CFO John David Rainey telling us here at Bloomberg the headline consumer is still reasonably healthy. The low-income consumer is more budget conscious. And Paramount's takeover of Warner Brothers Discovery is gaining steam. Bankers are preparing to sell $49 billion of debt to back the deal, with the financing coming from Apollo, Bank of America, and Citigroup. The deal will consist of a combination of investment grade and junk debt. That's your Bloomberg brief. John?
Hey, Hara, thank you. Thank you for the update. Up next on the program, renewing pressure on Iran.
If we don't get the right answers, it goes very quickly. It would have to be a complete 100% good answers. I'm not doing any relief until they sign an agreement.
Up next, we'll catch up with the former Chief of Staff to the former VP, Mike Pence. Marc joins us in just a moment, live from New York City this morning. Good morning. There's a few phrases in retail America that drive me absolutely insane. One is consumers are choiceful, and there's another one, investing in price. It's when things are difficult and they try and make it sound good. Walmart down by about 2%. Are they investing in price this morning?
They are investing in price. Absolutely, okay. John. This is what has definitely weighed on their margins, because investing in price can also be absorbing costs, which is essentially what they did. Walmart coming out and saying that actually consumer demand was pretty good. They actually did see strength there at the lower side. They did see ongoing choicefulness in terms of lots of decisions. At the same time, they said that it really was the fuel costs. The company absorbed, quote, virtually the entirety of the increases in fuel costs during the period because the company is prioritizing keeping prices low. The number of discounts rose 20% from a year earlier. So they're trying to gain market share by competing on price. Thought it was very interesting that Kroger's CEO came out this morning and told Bloomberg that they're planning the biggest price cuts in 2 years to take out Walmart. So it gives you a sense of this price war that's starting to try to capture customers and capture market share.
On a more serious note, this ain't 2022.
Yeah.
Consumer price tolerance then, consumer price tolerance now. And retailers are acting accordingly.
Yeah, they are ultimately trying to capture a bigger share. Although it does seem like in certain categories, price increases can go to the moon, like in chips and other areas of that nature. But for consumers, there clearly isn't the same kind of robust appetite to keep buying at any cost.
Energy prices are higher, costs are higher. That story still shaping this equity market. Equity futures negative by a few tenths of 1% on the S&P 500. On the Nasdaq, we're down by 0.4. In the bond market, yields turning a little bit higher, up by 3 basis points on 2s, on 10s up by 2. This move in crude, Brent back to 107 off the back of these headlines from Reuters earlier on this morning, citing 2 Iranian officials, 2 sources in the country, that the supreme leader wants to keep the uranium in Iran. Under surveillance this morning, renewing pressure on that country.
If we don't get the right answers, it goes very quickly. It would have to be a complete 100% good answers. And if we do, we save a lot of time, energy, and lives, most importantly. It could go very quickly. Or a few days. It could be a few days. I'm not doing any relief until they sign an agreement.
Here's the latest this morning then. Reuters reporting Iran's supreme leader pushing for its uranium to stay in the country. Tehran reportedly preparing a response to the latest peace proposal from the US. Annmarie joins us now from Washington for more. Hey, Annmarie.
Hey, Jonathan. Well, that directive from Iran that's being reported from the supreme leader on Reuters is really going to be a red line potentially in these negotiations because Prime Minister Benjamin Netanyahu had made it very clear for Israel, for the war to end, that highly enriched uranium needs to be taken out of Iran. So potentially this could put the president in a very difficult position. And for a little bit more insight on how potentially we could see this White House react, we are now joined by Trump's, in the first term, Director of Legislative Affairs. And of course, he was the former Chief of Staff to Vice President Mike Pence. And that is Marc Short. Thank you so much for joining us.
Thanks for having me.
So we have this new reporting out of Reuters, as the president said yesterday, right now, they're right on the borderline between getting a deal and resuming a war. What do you think he does with this basically escalation from Iran?
Well, look, I don't think there's any president who's been a better partner and more loyal to Israel than Donald Trump throughout his first term and his second term. But we are reaching an important point here because Iran is an existential threat for Israel, clearly. And they're not going to want to see a deal at this point, whereas the president is facing a lot of domestic pressure with energy prices continuing to spike, his numbers continuing to deteriorate, with midterm elections coming soon. And so this is obviously going to be a significant pressure point for him.
Yeah, his polling is going down as you see gasoline prices going up. We're north of $4.50 today. I just spoke last hour to Rita Sen of Energy Aspects, and she's on the road. And she says inventories are halfway drawn down now, and people are looking at June. Yeah. If we see north of $5 a gallon, does the president blink?
Like, I think it's not just north of $5 a gallon. It's jet fuel prices. Jet fuel, a lot of airlines continue to cancel flights. It's diesel fuel continuing to go up. I think there's some things the president's done, like waiving the Jones Act, that have kept some of this at bay. But I think that the question is going to be, does he want a deal? The president loves to have a deal. But I think if he gets a deal, Annmarie, there's going to be a lot of questions like, is this not just Obama 2.0? And when a lot of Republicans criticize sending pallets of cash to Iran, if we're basically saying, well, you know, as some have said, that we got 20 years now, is that really going to be that significantly different? And Iran has done this. This is what they've done for 47 years. It's continued to walk along a lot of presidents to say, hey, we'll negotiate this later. And they've continued to be the same menace for 47 years.
Yeah, they continue to drag their feet, and they have done with multiple presidents. But you have been in the room with President Trump. You know his instincts. If the domestic pressures get too much for him, does he then give a lot of concessions away?
I worry that he does. I think that right now, the president, again, it's hard to say there hasn't been somebody who has stood with Israel more than this president, and he has so far. But, Annmarie, I do think he's going to look at...
And tough on Iran. First term, maximum pressure. Second term, obviously, their strike.
Taking out Soleimani. But for a lot of things the president has done. But I do think that he likes to be the one who ends up making a deal. And so there's a lot of pressure for him to obviously get out of this and to lower energy prices. But again, for our partner, Israel, again, this has been an existential trend. They view this is our opportunity. Iran is weakened. Now is our opportunity to do this. And they know that if we back out, then China and Russia are going to continue to rebuild the military supplies in Iran. And it will become, once again, a threat to Israel and to the West.
You mentioned the midterm elections. We just had a bunch of primaries, but also recently the president said he's not thinking about Americans' financial conditions when he's talking about Iran. Now, I know some people would say that was taken out of context, but how difficult is that going to be for Republicans when they try to deliver a message before November?
The midterms are always going to be difficult in the term of the president, particularly when there's one party in power. So the Republicans have obviously the House, the Senate, and the White House. And American voters have always wanted to have divided government. And so you would anticipate already a significant year for Democrats. I think you add on to that what you've seen with the economy and affordability crisis, energy prices spiking, but also now the president has shown his muscle in winning primaries. But if you're basically showing that you want people who are more loyal to you, how does that play to general election voters? I think that it may be playing out to their strength in the primary season, Annmarie, but creating an even bigger hurdle for Republicans come November.
What does this mean for also the current Republicans in Congress? A lot of Republicans were very disappointed of the president yesterday going for Ken Paxton in Texas.
Well, that's obviously on the heels of taking out Republicans in Indiana, taking out Thomas Massie in Kentucky, taking out Bill Cassidy in Louisiana. And I think that you're going to continue to see, less and less done in Washington. It's already hard to get something done in the midterm election cycle, Annmarie, but I think even more so now because you're going to see those Republicans begin to break further and further from the president. So I would think there's going to be very little done legislatively. It seems that this housing bill that it seems to be Republicans, there's only a handful of Republicans that actually still believe in free markets because it seems like the vast majority of them are partnering with the populist left and deciding who can buy houses and who can't.
But if they're willing to break with this president, what does that look like?
It looks like things stalling. It looks like basically nothing else happening between now and November. It means that things like the president's desire for ballroom funding doesn't happen. It potentially means that more funding for the military doesn't happen.
I was going to say, we had an individual yesterday saying we're going to be running out of the military budget for the war in Iran. The president's asking for $1.5 trillion now. Does he get that before November?
I think everything gets harder now. Everything does. And so I would be basically wagering against anything else happening of consequence between now and November.
Does that mean that we see a president that's going to be more assertive on Congress and try to do things through executive order?
Well, I think that's already been the case, right?
Right.
I mean, this administration clearly believes they don't need Congress for much, and they think that they can do it just from the executive branch. That's going to become a bigger and bigger challenge after the midterms because there'll be a bigger and bigger clash with the legislative branch at that point.
Marc Short, thank you so much for your time
Annmarie,
this morning. Thanks for coming in. That was Marc Short, Jonathan. Of course, Trump won. He was Director of Legislative Affairs and also the Vice President Mike Pence's Chief of Staff. Interesting, the beginning of our conversation, when it comes to the war with Iran, you see these reports like Reuters with the Supreme Leader having this directive about enriched uranium. Potentially, this can make it much harder at the negotiating table with gas prices going up. Marc Short is worried that this president blinks at the table.
Annmarie, appreciate the update. Thank you. Annmarie in the nation's capital. We all understand the seriousness of what's taking place in the Middle East, but I have to tell you, to take a step back, the degree of fatigue in financial markets for investors tracking this story is off the chart, just totally off the chart.
You can feel it. Look, I'll be honest, I have fatigue with it because there's no way to analyze it. There's no way to get an edge on it. There's no way to know. Tell me when it's over. Tell me when it's escalating. Tell me what I can price in. Tell me when I have to care if it's a crisis. Throw in some Ebola. I can't pay attention to that because I've dealt with enough of that stuff.
It's like, that.
But it's, it's just, there is a crisis fatigue right now in markets, especially given the overlay of optimism and enthusiasm and change going on from AI. Doesn't mean it's not an important story. It's an incredibly important story. It's just hard to analyze, so people are just trying to put it in the back.
We're drawing down inventories aggressively. That's cushioned the story so far. But ultimately, it's unsustainable, which is why the status quo can't continue for much longer. Maybe that's the good news. Maybe you get a breakthrough. I don't know.
If it's not possible or if it's going to be so bad, it's not going to happen, right? That's what we've heard.
Up next, the BNY CFO, Dermot McDonogh. That's next. This is Bloomberg. Live from New York City, welcome to the programme. Equity futures so far this Thursday morning. Good morning to you. Negative by about 0.3% on the S&P 500. You see the Nasdaq down by 0.4. You'll notice in the bond market as well, Treasury's a little bit softer, yields a bit higher. 2s, 10s, 30s, yields up by about a basis point now on 10. Still around 460. The 2-year just north of 4%, up another 3 basis points at the front end of the curve. A lot of these moves born out of the energy market this morning, and these moves in crude, Brent and WTI. Brent crude up by 1.7% to around 107. It's the story you're all sick and tired of hearing about, but it's the story driving financial markets this morning. It came from Reuters, a couple of headlines suggesting that the supreme leader in Iran would like to keep the uranium in the country, which makes it difficult to get to a deal with the United States.
Yeah, this market doesn't want to have to focus on the internals of coming to a deal because it looks pretty messy and frankly unsustainable to have any kind of agreement given the position of both sides. It's interesting to note the dissonance between how much people have moved on and the fact that they can't really move on because this story is fundamental to the underpinnings of the economy. I mean, just looking at Walmart's earnings gives you a sense of just how much cost is being absorbed by the fuel costs going up that hasn't been passed along yet, but is unsustainable if it continues.
Is that good news for the Federal Reserve that we're not seeing that pass through? This is different. The more obvious story might be a growth one further down the line, because you can see the nervousness right now about the inflation component of all of this. We've priced out the easing of the Fed. We've priced in tightening of the ECB at the Bank of England. This Federal Reserve, reading through those minutes in the last 24 hours, they seem very, very nervous about the next several months.
Yeah, partly because inflation there is no sign that it's come lower. In fact, it's actually accelerating higher, and you haven't had 2% inflation for more than 5 years. They now see a longer path to get down to 2%. And you ask, does it make it more comfortable that you aren't seeing any pass-through at the likes of Walmart? No, the answer is absolutely not, because you're seeing the pass-through for airline tickets. And frankly, there are other inflationary components as well tied to the AI story. So you can strip out everything that you want, but that target isn't getting back to that 2%, at least not in the near future.
And those buyers in that tech space, price insensitive, as we've seen big time in the last 12 months or so. More data later this morning, 8:30 Eastern Time. Jobless claims, that's just around the corner as we count you down to the opening bell, 2 hours away. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Staying on Walmart, we are seeing those shares falling 2%, even after it posted another solid quarter of sales growth. But as you said, the company warning that rising fuel costs are starting to hit its shoppers and its own profits. Executives saying that lower income consumers are becoming even more budget conscious, while the company itself is absorbing much of the fuel hit to try to keep its prices low. Turning to shares of IBM and other quantum computing stocks, they are surging in the pre-market on this report by the Wall Street Journal that the Trump administration is preparing roughly $2 billion in grants for the sector, with IBM set to receive the biggest award at $1 billion. And we end on shares of Tchir. They are falling in the pre-market. It just reported results. Shares are down 3.4%, even after it posted better than expected earnings. But looking under the hood, results show that farmers are still holding back on purchasing those bigger, pricier equipment. And Tchir says the reason results have held up is because of the AI boom. John.
Yahira, thank you. Thanks for the update. More from Yahira later this hour. On our radar this morning, Walmart moving lower in the pre-market. The retailer posting steady sales gains but flagging higher fuel costs. The CFO, John David Rainey, saying, quote, the headline consumer is still healthy. The low-income consumer is more budget conscious. Elsewhere, Anthropic on track for its most profitable first quarter. Strong demand for its AI software driving a surge in revenue. The numbers adding fuel to the race with OpenAI to go public. And finally, JPMorgan boss Jamie Dimon arguing the AI transition can occur without sweeping layoffs.
I think we'll be hiring more AI people and probably less bankers in certain categories, and it'll make them more productive. Your job will be the same. You'll just be much smarter at how you execute that job. But we will retrain and redeploy our people.
Diamond's comments underscoring a broader industry shift towards automation throughout the financial workforce, and I think setting him apart with some of the comments we had earlier this week from a certain Standard Chartered.
Yeah, and he called those comments indelicate when you talk about lower value human capital. Nonetheless, an increasing number of CEOs are saying whether you like it or not, change is coming. Whether you like it or not, our economy is changing and we have to adjust and adapt or else we will become obsolete. What I learned when I talked with Lori Beer yesterday, who is the Chief Information Officer at JPMorgan, was this is a highly uncertain time. There isn't a clear destination, and it is incredibly difficult to have people sit with that uncertainty. At the same time, people who thrive are the ones who can deal with that uncertainty and keep shifting. How do you get this message out, though, when you have a lot of mixed messaging and when you have some of the executives coming out with indelicate phrasing?
I was smiling. Didn't Bill used to work with Jamie? I think they did.
I will have to
a while
check that.
back. Yeah, I think they did. So I imagine he was smiling too when he saw those comments. You know.
Somebody who tends to put foot in mouth.
Hiccup.
Yeah, exactly. But he's done that before.
Yeah, he's not alone. This week, we've seen a lot of that. Let's turn the page and stay on the financials. America's oldest bank and the first listing on the New York Stock Exchange getting a little bit of a revamp today. The Bank of New York is set to begin trading under its new ticker, BNY. Joining us now is BNY CFO Dermot McDonogh. Dermot, good to see you, sir. Welcome to the programme.
Good morning. Thanks for having me.
You guys have had a fantastic run, whether it's under BNY or BK, and I don't think this story is talked about enough. Alongside Robin, the best performing large bank in this country over his tenure. Now, at the very beginning of life at BNY, you were the architects of the Treasury market, one of the early movers in this whole financial space. How different is this institution now compared to back then?
So look, first of all, thanks for having me. America's oldest bank, 1784, storied institution, founded by Alexander Hamilton, who became the first Treasury Secretary, first loan to the US government. And so we're very proud of our place in the financial market ecosystem, and that's evolved over the last 242 years. When tickers first became a thing in 1969, BNY wasn't available, so we went with BK for America's oldest bank. And now we have the opportunity to sync up how we present ourselves to clients and shareholders with the ticker. So it's a great day for us.
Hamilton was an incredibly intelligent man. I have my doubts as to whether he would have imagined the position that we're all in right now, staring down the technology that is just on the horizon. How different are things going to be for your institution? And when you think about AI, I imagine you're not thinking in the terms of low-value human capital. Can you tell us in the way you are thinking about the incoming technology?
We have a very, very different strategy on AI. Jonathan, I think you've been down to our headquarters. You'll have seen the ledgers from that time. You'll have seen our CTOC Centre, which is quite a modern, where we manage the markets, 20% of the world's investable assets flowing through our pipes every day. So, you know, you've talked earlier about a lot of uncertainty in the world. The only thing that's constant in today's world is uncertainty. And so we've embraced at BNY AI as a superpower. It's part of our strategy. It's part of our transformation, and I think we've done a pretty good job at demystifying AI for our people. We say inside the walls of BNY, AI is for everyone, for everywhere, for everything. And we have two strands to it, individual AI and enterprise AI, where we focus on how can you use AI as an individual to become more productive and to upskill yourself. And then as a firm, how do we use AI as a strategic superpower to make clients have better services, better goods? How do we serve? How do we grow? And more importantly, how do we create capacity within the firm to grow?
That's the word that interests me, capacity. So when we talk about AI, and when I hear the C-suite discuss it, they'll talk a lot about efficiency. We'll have a conversation about job losses. Maybe they'll spend some time on an improved product offering for customers. We'll spend a bit of time on that. Capacity is the interesting component of this. Does it create capacity and allow you to do things that maybe you might not have been able to do several years ago? And when you think about the spaces that it opens up for, say, BNY, what does it mean for you?
I would say, in a word, AI for us means growth and opportunity. And things that we thought we couldn't do before, we're now able to do and do at a faster pace. If you kind of go back to what I said in terms of 20% of the world's investable assets flowing through our pipes, we settle 95% of the US Treasury market every day. That gives us a lot of data, and we'll be able to, with AI, to unlock that data, provide greater insights and greater information, be able to develop greater data products for our clients in the whole world of digital assets as well. I think we can power that with AI. So actually, AI for us is, we were quite optimistic in terms of our ability to grow and transform, as you've seen in our results over the last couple of years.
What's the main note of growth, given the fact that people used to think of BNY as being sort of where money markets funds go and get parked, and it's the collateral bastion? You talk about 20% of the world's assets. How do you grow profitability given the low margin aspect to those transactions?
So I think in many ways BNY is a unique institution. we have several businesses, and we have strong competition in each of those businesses. But when you add them together as a combine, we're pretty unique in what we can offer our clients as a collective. So what we've done over the last couple of years to a good success is our ability to sell multi-line of business to single clients and unlock the firm and de-silo the firm and deliver a more holistic brand to our clients. And you've seen that in record sales revenue in Q1 of this year, record revenues this year, and a tripling of the stock price over the last 3 years. So clients are noticing the transformation, our shareholders are noticing the transformation, and more importantly, our employees are feel empowered and energized by what we're doing at the institution.
The total number of employees at BNY peaked out in 2023, close to 53,000, and they've fallen considerably since then. It's been a pretty contractionary headcount story, even amid some of the growth in profitability. Do you expect it to continue shrinking because of some of the capabilities and efficiencies that you're putting out there?
So I think the rationalization over the last couple of years, we've largely dealt with through attrition in terms of each firm has a steady amount of attrition each year. So it's not been large-scale workforce layoffs. It's like we've kind of figured out how to manage the workforce in a more strategic way. And it's been kind of taking back control of our expense spend and reducing duplicity in the firm, implementing our platform's operating model so we can deliver more holistic set of products to our clients. And that's taken excess capacity out of the firm in a more strategic way, which I think our employees are very pleased to see.
Well, we're seeing the performance, strongest sales quarter, I think, in the firm's history more recently. Can we talk big picture about financial markets and more broadly capitalism? We heard over the weekend people get booed whenever they mentioned AI. I think that a lot of these institutions have totally lost control of the narrative right now. And I mentioned Standard Chartered, and I'm sorry to keep beating up on that bank, but the language that was used to describe this technology and the people that worked at the institution was deeply derogatory. And for a lot of people that work in capital markets right now, they themselves might be losing faith in the future of this industry. How do we make sure that people stay engaged with capital markets? I know that you're engaged also with the Trump accounts as well. Is that a feature in this effort to keep this country engaged in capital markets at a time of deep skepticism over the future of capitalism and of technology?
So look, we're very, very privileged as an institution to partner with the administration on Trump accounts. We believe it's a very important public policy initiative. It's giving the kids of today a future in the stake of America tomorrow. And, you know, it's a real privilege. We're a GSIB. We're a key part of the financial market ecosystem. We serve the government every single day, and we're very proud to be one of the first institutions to match the Trump administration's initiative by doing it for our own employees. So financial literacy, financial education, giving people a stake in the economy of tomorrow is really important, and we're very proud to play our part in it.
What other things can we do?
We're very focused as well on home ownership. We launched an initiative this year where everybody who earns less than $100,000 a year who wants to get their step on the property ladder, we give them assistance to do that. We do a lot of digital education about how to save and how to, build for the future. And I think we're also very focused on wellness and health benefits to make sure we're a leader in that. So when people join BNY, they not only join for a career, they join to be part of a family.
I think we often have doubts about the consumer sentiment numbers we see, Lisa, on a monthly basis, and we say that can't be real. People can't be this downbeat about this economy compared to, say, GFC and the pandemic. But maybe it is real. Maybe they just look at the future right now, the technology, the language that's used about the labour market, and have their doubts about where they fit in and what capitalism ultimately is going to mean to them in the next several years.
A lot of people do say that the level of uncertainty for the future has led to a lot of discomfort. Last night at the dinner table, I will say that my 14-year-old said, I'm worried about having a job. I don't know if I can get one in this world. I mean, these are actually things that they're talking about.
Have you heard about Casa Lisa?
Well, as somebody who grew up in Ireland, I was always worried about getting my first job. We came from an economy that had a lot of unemployment. Everybody had to emigrate. And I emigrated, and here I find myself in New York. So I think if you're a glass half full person, there's still a lot of opportunity out there for those who want it.
We're lucky to have you here in New York, sir. Thanks for being here. We appreciate it.
It's a pleasure. Thank you.
Thank you. Dermot McDonogh there, the BNY CFO. If you're just joining us, welcome to the programme. Equity futures a little bit lighter this morning. We're softer. We're down across the board on the S&P by about 1/3 of 1%. With an update on stories worldwide, let's get your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. We are seeing Kroger shares falling nearly 5% in the pre-market after Walmart's cautious results. But in an interview before that, the supermarket chain's new CEO told us here at Bloomberg he's looking at major price cuts to win back market share. Kroger aiming to protect margins by trimming expenses by directly importing its merchandise. Meanwhile, taking a look at Nvidia shares, they are falling just slightly in the pre-market. The tech giant reporting another blockbuster quarter with record sales and income. The results topping the average analyst estimate, but some are questioning the sustainability of its growth, especially amid higher competition. And SpaceX filed for what stands to be the largest IPO in history with a $75 billion funding target. The company revealing billions in losses, along with a plan to give Elon Musk near total control over the company and up to 1 billion shares. The company's goals include a human settlement on Mars and data centers in space. That's your Bloomberg brief. John?
Yahira, thank you. Thank you for the update. Up next on the programme, a fresh warning from Wall Street.
You have bond rates going up. Inflation is a little bit higher than people thought. But I'm not surprised. The notion that somehow people said they'll never go up is the wrong notion. They could be much higher than they are today.
Up next, we'll catch up with Sam Lynton-Brown of BNP Paribas from New York City. You're watching Bloomberg TV. Equity futures this morning down by 0.25% on the S&P 500. Upset just a little bit by this move in the bond market. The front end of the curve, twos this morning. Yields higher by 4 basis points, approaching 4.1% all over again. With energy elevated up 2% on WTI, on Brent back to about 107. Some disruption in the negotiations potentially between Iran and the United States as the Supreme Leader says the uranium must stay in Iran. Under surveillance this morning, a fresh warning from Wall Street.
You have bond rates going up. Inflation is a little bit higher than people thought. But I'm not surprised. The notion that somehow people said they'll never go up is the wrong notion. And so companies like us prepare for higher rates, lower rates, and figure those things can happen. They could be much higher than they are today.
So here's the latest this morning. Global bond yields hovering near levels not seen since the great financial crisis. The JPMorgan CEO, Jamie Dimon, warning investors that interest rates could continue to climb. Sam Lynton-Brown of BNP Paribas writing, the market sees resilient growth despite higher energy prices and higher rates. Our view is essentially that the bifurcation can continue in the near term. Sam joins us now for more. Sam, good morning.
Good morning.
Let's extend some of those issues and welcome to New York. Let's talk about the prospect for interest rate hikes as well. As a team over at BNP, I think the research team doing a decent job recently of really highlighting the risk of that actually materialising this year. Can you walk us through just how high or how low the bar for hikes actually is?
Yeah, look, our view at BNP Paribas has been that the Fed wouldn't be cutting rates this year. That's been our view since December of 2025. And we're quite open-minded to the idea that it's possible the Fed could actually be hiking rates. I think the key is we'd need to see even more strength in the labour market. So an unemployment rate beneath 4%, accompanied with some type of de-anchoring in long-term inflation expectations across the panel of what the Fed look at, that could be consistent with a Fed that really becomes open-minded to rate hikes.
They're the conditions. In the beginning, do you have to change the communication, drop the easing bars? We were talking about the Federal Reserve minutes that came out yesterday. Lisa, like me, like everyone, surprised the easing bias is still there, given the minutes we just read.
You do need to see that sequencing of communication change. So you'd need to see the easing bias dropped, you'd need to see a tightening bias included, and then you may be in a situation in which the Fed would be more sort of openly signalling that the rate hikes could be coming.
Did the minutes indicate that some of the Fed members might be prodded to look through AI-related inflation to some degree?
I think as it relates to AI, the challenge for the Fed is what it's going to mean for inflation in the near term. Because in the near term, the sentiment effect is clearly very positive. It's driving stocks higher. That's having a positive effect on consumption through the wealth effect. At the same time, you've got a huge amount of capex, which is also supporting economic growth. So there's clearly a demand impact near term. The supply impact is there to some extent as well, but it may only come later. So the view that we've actually got at BNP Paribas is AI will be inflationary in the near term.
At this point, it seems like people are readjusting their sense of what the danger zone is in the bond market with respect to how much it curtails risk appetite. What's the new metric for the danger zone? I'm using Max Kettner's term over HSBC for, say, 10-year yields or benchmark rates. And does that highlight how maybe these aren't such restrictive rates at the Fed currently to the rate hiking point?
It depends why rates are rising. This sell-off has been predominantly driven, at least the latest leg in the US, by higher expected short rates. And the reason we've priced out rate cuts and we're beginning to price in rate hikes is because of how spectacularly strong the economy is performing. The labour market's performing better than anyone expected. Claims are low. Weekly ADP hiring is high. NFP is surprising to the upside. So the market's really having to discount this backdrop in which the economy is stronger than expected. So if rates are rising for good reasons, so to speak, it means risk assets, as we've seen with credit, as we've seen with equities.
It still is problematic. I mean, if we get to 5.5%, it's still 5.5%, even if it's for all the right reasons.
I think it really depends. If that's reflecting higher expectations of neutral rates because growth is just so strong, risk assets may well be OK with that.
Are rates rising for the right reasons over in Europe?
I don't know what you possibly mean. Yeah, look, in the UK, we've clearly had some fiscal-related sell-offs recently, but that's actually come back now. I think across European bond markets, across EGBs, they are actually in large part rising for the right reasons. At least at the long end of the curve, it's predominantly related to fiscal stimulus in Germany, which remains a very important story and, in our view, an important driver of why European growth may be actually quite resilient.
So if the ECB hikes in June, you don't consider that a hawkish policy mistake?
No, I don't think so. The ECB need to respond to higher inflation expectations given the energy shock. Whether or not they hike more than our central case, we have 2 hikes, June and September. If they hike more than that, then I think we could be getting into the territory where the growth impact will be quite negative, and therefore we could be looking in 2027 at some reversal of those hikes. I think the UK is a similar story. Right now, the market prices in hikes, and then it doesn't price a reversal of those hikes. That looks a bit wrong to me. It looks a bit wrong to us. We think the front end of curves could actually flatten a little bit in that environment.
What is a policy mistake of not hiking rates? What does that look like, and how realistic is that?
It looks like 2022, where you wait to see wage growth evidence before responding to the shock, and at that point, it's already too late, because the second round effects have already kicked in.
Sam, that's scary stuff. A repeat of 22.
And we're not in that environment because the starting point in 2022 was, for example, in Europe, rates were at 0 and inflation went to 5. So we had a negative 5% real rate. This time, inflation was at 2, rates were at 2. So it was 0% real rate. So you had a 5 percentage point differential in real rates. And the shock is, thus far, much less severe. But central banks remember 2022. They remember perhaps being a little too slow, and I think that's why you have this hawkish bias.
Sam, it's good to see you. Thanks for being here. Sam Lynton-Brown there of BNP Paribas, haunted by 2022 over at the ECB and maybe not 2008 or 2011, which is perhaps what they should be reminded of.
Well, but this is the ultimate conundrum, right? On one hand, you could say if they hike rates, they could precede some sort of crisis in growth. You could also say if they don't hike rates, you could precede what could be a spike up in inflation. The fact that we could have a really good argument on either side gives you just how inconclusive this moment is.
Lose-lose.
Exactly.
This summer as a central banker. OK. Up next on the programme, we'll catch up with Laurie Calvasina of RBC, David Bellinger of Mizuho, Barbara Reinhard of Voya Investment Management, plus this one, the US Undersecretary of Defence, Emil. That's an important conversation in the next hour on Bloomberg Surveillance.
There's still this institutional bias in favor of the U.S. equity market going higher.
The bull market still deserves the benefit of the doubt.
We eventually will see AI adoption spread.
It's accelerating, and it's not going to slow down. This technology is not going to stop, so we have to invest in it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. We're pulling back once again. We're down by 0.25% on the S&P after snapping a three-day run of declines in yesterday's session. This morning, the losses resume. We're down by 0.4% on the Nasdaq, and decent numbers from Nvidia not helping out this morning. In the bond market, yields are higher again, particularly at the front end of the curve. Twos are higher by 4 basis points to 4.1%. In the commodity market, energy is inching higher as well. Brent crude up to 107, up by 1.9%. Going into this data in about 29 minutes' time. Jobless claims in America.
It has been an incredibly low figure that just seems to get revised lower and lower. We saw the lowest initial jobless claims going back to 1969 a couple of weeks ago. Is this still a viable metric at a time where there's so much transition and people are measuring the economy in such a different way? I ask this because we're talking about the replacement of lower value human capital with bots. I mean, it's horrible the way that Bill Winters talked about it. It's not showing up in the numbers. So people are saying, just as we were having a conversation earlier in the show, is it right? Are we reflecting the right things? What does this mean? What is the signal telling us?
Let's talk about price. There's always signal in price, and the signal and the ability of corporations to pass on that price. Notable what's happened with Walmart this morning. You've mentioned it already a few times today. This has been a central question in economics. Do we need to hike interest rates? How do we measure that? How do we gauge that ahead of time? A couple of ways of doing that. You start with the labour market. How tight is this labour market? Is consumer price tolerance high enough to pass on higher costs, to allow those higher costs, those higher prices to become embedded more broadly in the economy? Is that something the central bank needs to respond to? I know it's a very sort of narrow subset of companies we're talking about right now, but what you talked about from Walmart, from Kroger, I think is difficult to look at that data and suggest that what we need right now is interest rate hikes.
Walmart increased the amount of price cuts, discounts that they did across the board. They absorbed almost or virtually the entirety of the increase in fuel costs, and they took it as a hit to their margins, which is why they came in with lower than expected earnings, even with a consumer that all in all is holding in strong. Then you saw Kroger's CEO coming out and saying that they're planning the biggest cuts in years because they want to compete better with Walmart. Does this give comfort to the Fed? On the flip side, you have inflationary inputs from AI. You have inflationary inputs from other metrics like airline tickets. So it opens up this interesting question. Are these the places that are cutting prices because they don't have the pricing power on some of their products that, say, some of the airlines do, where people still want to travel, and some of the luxury products? Are we seeing inflation in pockets in this dual economy where you're seeing very different speeds in different places?
Get to neutral, stay open-minded. Get to neutral and stay open-minded. David Kelly said it yesterday, enjoy the summer. If you're a central bank right now, take the summer off, don't do anything. Get to neutral, stay open-minded. There's no argument for an easing bias either, by the way, over this Federal Reserve. And see how this summer turns out and see if we can address the issue. Look, I know everyone's sick to death of this situation in the Middle East and the ongoing headlines. The blockade continues. Then you get more headlines from Reuters on Iran and keeping uranium in the country, and crude starts to move higher again. But ultimately, it's a central issue. It's a central issue for the outlook for prices and the outlook for rates.
You say get to neutral, and yes, there is the Iran situation.
I don't mean take rates to neutral or whatever. There's a big debate about that. I just mean communication-wise.
But what's interesting to me is that actually you could make an argument to that point that we are at neutral. And I think that that's the easing bias that gets removed. That's another way of thinking about it, is if you get to neutral in your guidance, you're saying this is ultimately a neutral rate, which you can make an argument about because the economy is going so strong.
That Federal Reserve meeting will have Kevin Walsh, and it will also have Chairman Powell, just as Governor Powell. So it's going to be an interesting one in about a month's time. Coming up this hour, Lori Calvasina of RBC, is SpaceX and OpenAI prepared to go public. David Bellinger of Mizuho breaking down earnings from Walmart, and US Undersecretary of Defense Emil as the Pentagon weighs the risks of AI. We begin this hour with tech-hungry investors gearing up for the biggest IPOs in history. Lori Calvasina of RBC writing investors we spoke with were interested in what else might offer opportunity beyond semis, tech and AI, but had difficulty envisioning what those were. Lori joins us now for more. Lori, good morning.
Good morning.
We're going to get a ton of IPOs, some major IPOs in the next 12 months. Do you sense there's enough demand out there to absorb all of this supply?
To be honest, I try to stay out of those conversations as much as possible. But I do think that what we've seen within the AI theme itself is a bit of a broadening of the AI theme, that people have, kind of owned what they've owned, and they're interested in looking for new things within that theme. And, to the quote you guys had earlier when I was out seeing investors in Europe last week, I mean, it was really funny, John. Nobody wanted to talk about the broader market. I would sort of like tell people, this is where our target is, this is why, this is how we're baking in inflation, damage from the Middle East. And they're like, okay, that's fine. Let's talk about sectors. And so just really wanting to go through and look at the areas that are cheap. So things like financials, healthcare, energy, and sort of debate, is there opportunity to move it into some of these things. And I think what people were really struggling with was, on the one hand, they felt like they've been in a lot of these semis names, and maybe it's time to take some chips off the table, but then you go and look at the fundamentals of all the other stuff, and it gets quite hard for people. So to me, that illustrates this moment that we're in the market perfectly, which is, just kind of clinging to this stuff that has bigger cap exposure is causing us to creep up. But then we have, like those 3 down days, people kind of feel this urge to pull back, and it's sort of like they're fighting within themselves.
I think it depends what seat you're in right now. I had this conversation earlier this week. If you're a technical strategist and just looked at the charts of semis, I can see why you'd get nervous, because we saw semis just explode higher and become really detached from, say, the 50-day moving average. We've seen all of that analysis. But if you're a fundamental investor and you just look at valuations and the earnings profile of some of these companies, any reason to worry? Well,
so I would say on the valuation metrics, and we look at the Russell 3000 semis, just that kind of GICS level 3 industry, and we have data, I think we go back to 1989, and we look at like a median PE. So it's not a cap-weighted time series, but when you do that relative to the broad market, we have crept up to recent highs. We're not at all-time highs. Now, obviously, there are stocks where that statement does not apply. So I would say valuations do feel like they've got a little more pressure on them than they did a few months back. When I look at earnings revision trends, though, for semis, this is what I think sort of captures, again, this complexity of the moment. We're seeing, a lot of areas of the market that had been at very high rates of upward revisions and pulled back. You can say that for probably like 7 of the 11 GIC sectors. If you look at semis in particular, we're still up around peak-like rates of upward revisions. So earnings sentiment is really high. And that's normally kind of a scary chart as a strategist, because you don't want to be there when it starts moving down. The problem is, I can't sit here with a straight face and tell people to say short that space or sell that space, because if you go back and look at the history of the past 30 years, sometimes we get stuck at peak for a couple of years. So what I've told people is we just have to be really, really vigilant in terms of watching that area of the market. It does feel to me like there's some vulnerability to profit taking at some point, but that does feel more short-term in nature.
You kept talking about how people are looking to invest, and we keep hearing this, cash to put to work. At what point does the cash run out? I mean, is this just a big transfer right now because people see cash as a liability due to the inflation in the economy?
Well, look, I would say, my bread and butter are long-only investors, and they're really not allowed to sit on too much cash, right? They need to be fully invested. So it really is about kind of moving the chips around on the table. I think it's a little bit different if you're talking about retail investors. And that's where I think sort of looking at the labor market and the ability of the retail investor to kind of keep goosing stocks up. I think the cash issue matters there a little bit more. But in my world, people feel like they have to put money to work.
I do have to get the sense of the danger zone. I'm sorry to keep coming back to it. Max Kettner, thank you. Copyright, I understand. With respect to yields, and at what point that will start to crimp some of the appetite and be an alternative in terms of income driver for investors. Are we getting close, or has the bar just shifted higher?
It's not an answer. You can't just look at yields in isolation, and I think that's what's hard about this moment in time. And so I'm going to, if I can indulge you in a little bit of math, and Tom Keene would probably throw something at me at this point, but if you look at my valuation model, so what I've got baked into my 7,900 forecast, which, by the way, is a 12-month number, it's like a 6% return. I've never seen people so annoyed about me being bullish with a 6% return. But anyway.
Who got annoyed with you?
People want me to be bearish. It's really funny.
Who are those people? Where are they coming from?
I'm not going to say specifically, but I'm saying I am feeling a little bit of the... Not Lisa, just like out in doing the course of my day-to-day.
Is this still a hated bull market?
Yes.
Is that what you sense? That's crazy.
Yeah, I think in certain camps. I think in certain camps. But going back to the valuation, I've got 3.3 CPI baked in, a flat Fed, and 4.5 10-year yields. I take the consensus earnings, haircut them by 5%. Within that, I leave the AI numbers alone, and I take everything else down by about 7.5%. versus consensus, not an overall cut. That gives me 79.29 as a fair value estimate for the S&P in 12 months' time. If I put 3.8 on inflation, if I take a couple of hikes and put them in, and 5% on 10-year yields, use the same earnings, I can get you to 7,400 on the S&P, which is about where we're stuck now. But if I want to really bear that number up, I've got to cut the earnings. And so if I cut earnings, not just haircut the consensus by 5%, but put a 5% year-over-year decline on the 1Q27 earnings, then I can get you 6,300. And all that is to show is that it's a sliding scale. The PE is negatively impacted by the Fed, by 10-year yields, by inflation. All of that stuff moving up pushes the PE down. But the PE is then used against the earnings, and the earnings forecasts are astronomically strong right now. And even if we haircut them, kind of that non-AI part by the typical, number by which they're too high, I'm still getting a really reasonable number on the market. I can get you up 6%, I can keep you flat. But if I want to take you down, I gotta attack the earnings, and you gotta attack the AI piece of that, not just the rest of it.
We've gone over this as the 2-year just turns to 4.1%, by the way. Energy shock, rate shock. For it to become an earnings problem, you've got to believe it becomes a growth shock. We haven't seen that yet. You just haven't seen that yet.
Because the note of growth right now is not stemming from consumer demand and isn't stemming from some of the areas that are getting hit by these other areas. It's being driven by a secular overlay that is independent from cycles because of the hope of what AI can accomplish.
10s right now at 460, not the danger zone.
Nope.
Apparently. To your point, I'm with you. At some point, you climb fast enough that investors start to get a bit jittery about the potential for a hit to growth. But clearly, based on how things have played out, we're not there yet.
Love the mathy morning, actually.
I like that too.
I actually really love that, because I love that people are saying, come on, Lori, bear it up. And she's thinking, how do I bear this thing up? And it's like, all right, I got to cut this over here. But it gives you a sense of how high the bar is for the...
It's been a hated bull market.
It has.
And look,
since GFC.
Yeah. If I could just say one more thing. I think there's this whole accusation of the equity market has been complacent and doesn't understand what's going on in the Middle East. I don't think that is true. I have talked to enough investors that are worried and wary and paying attention. But I think that if you're a portfolio manager who's looking at the earnings and looking at the companies, you are getting hit in the face every single day with the strength of this AI earnings story. And by the way, the rest of the market is filling people's ears with commentary about how they're really good at managing through crises, and their numbers haven't collapsed either. So from a bottom-up perspective, it is very, very hard to just make the worst-case scenario assumptions and make that your base case.
I think there's some career risk involved as well. If you're a PM right now and you're not involved in some of these names that are driving higher, you get to year-end and you weren't in it, that's a big problem.
Especially because inflation is going to create a real negative return for any cash or safer instruments. What's the big risk right now? And ultimately, right now, the risk for a lot of people is not being involved in this.
I'm just going to remove Laurie from this part of the conversation because I'm sure she'll want nothing to do with what I'm about to say. I also think there's a lot of skin in the game now with these major IPOs set to come to market in the next 12 months that people need to speak quite favourably about this equity market to make sure the dancing continues, the music keeps playing, and we get this away, because there is a lot of money to be made going into year-end.
All the fees tied to IPOs.
Oh, astronomical.
Astronomical. All the bridge loans, all the other deals that would come to the fore as a result of this. There clearly is an incentive to talk favourably and see them all go off as well as Cerebrus.
Could bring Laurie back into the conversation now, Laurie. If TK ever throws anything at you, throw something back, all right? Laurie Calvasina of RBC. Laurie, thank you. Appreciate it. Thank you very much. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. Stellantis unveiled a sweeping turnaround plan focused on boosting profits by concentrating investments on a handful of key brands. The company says it will invest $70 billion through 2030, launch more than 60 new vehicles, and cut billions in annual costs. But investors appear skeptical, with shares down 4% in the pre-market. Samsung reached a deal with its chip workers to avoid a strike, agreeing to a long-term bonus program tied to profit targets. The company could distribute as much as 40 trillion won over 10 years, with employees receiving on average annual payout of about 513 million won, or $340,000 if targets are met. And AI agent Anthropic is on pace for its first profitable quarter. The company is seeing a surge in revenue driven by demand for its AI software. The cloud maker expects to post nearly $11 billion in revenue for the second quarter, more than doubling from the prior 3-month period. That's your Bloomberg Brief. John?
Arya, thank you. Thank you for the update. Up next on the programme, the morning calls, plus David Bellinger of Mizuho on Walmart's mixed earnings report. That conversation just around the corner, live from New York City this morning. Good morning.
Right now, I think it's all hands on deck. There is so much money to be made in the AI space that whether it's 4%, 6%, 8% on interest rates is trivial. Unlike .com, where I think everyone was excited, there is so much angst around this. From a personal level, I don't think we've ever seen anything like this.
That was Peter Tchir of Academy Securities. Really thoughtful conversation. Catch the full conversation on Bloomberg.com and on the Bloomberg terminal. Really echoing what Lisa's talking about. At what point does this bond market start to cause real problems? Haven't really seen them. Saw a 2% move on the S&P 500 over 3 sessions. In the equity market this morning, we're down by 1/3 of 1%. On the Nasdaq, we're down by 0.5. If you check out the bond market, yields starting to creep a little bit higher. Lisa keeps talking about the so-called danger zone that Max Kettner over at HSBC talks about. 460 apparently isn't it. Yields up by 2 basis points this morning. 4.1 at the front end of the curve apparently isn't it. Yields up by 4 basis points on 2s. And when I saw those minutes yesterday, and they were super hawkish, by the way, I looked at the price action and the market reaction to them. Pretty tepid stuff.
Because they don't even begin to approach the hawkishness of a market that's pricing in a rate hike come early next year. And they're saying, what's taking you so long? Why are you then maintaining an easing bias at all? That, to me, is the most dovish sign of all, that there was no argument in there for keeping the easing bias in place. There is the skepticism being played out in the bond market, but all the equity analysts say it doesn't become a problem because ultimately it's rising for the right reasons, which is that growth has been strong. If it starts rising for the wrong reasons, say that the U.S. government debt is now $35 trillion and potentially rising, and then that's potentially a problem given how quickly it's moved up, that could be a different story, but for now, it isn't necessarily putting an end to this.
Max Kettner, cushioned by earnings.
Yeah.
Right. CIBC, Chris Harvey, 80-20 new price target year end on the S&P 500 earnings. Earnings. Every single upgrade we've seen to the S&P 500, whether it's Laurie Calvasina of RBC, whether it's Barclays, Morgan Stanley or Ed Jardini, they've all pointed to the same thing. Powerful earnings.
And we've seen it in terms of how much has been delivered above it and beyond. And it isn't just what we're seeing in big tech, but big tech is certainly driving it. And the margins are just incredible. I mean, some of the earnings growth that you're seeing in NVIDIA is like 95%. That's the expectation for next quarter, year over year. If you take a look at their sales, they've doubled since the first quarter of 2025. This is catastrophically amazing things. It's not exactly a phrase that I'm ever going to use again, but going forward, that's what people look at.
You might do.
I mean, it's
a bit off-brand. But you might do.
Catastrophically amazing. I think it's right on brand.
Let's get you some morning calls this morning. With one stock in focus, Nvidia. First up, Goldman Sachs raising its price target to $285, seeing further upside potential in rising capex expectations. A second call from Morgan Stanley, raising its price target to $288. The analyst calling Nvidia the best value in semis. And finally, Baird hiking its price target to a street high, $500. The firm's model showing gains in inferencing and growth well ahead of hyperscale AI capex. That stock is negative by about 0.1% this morning. Sticking with earnings, Walmart shares falling in the pre-market after solid sales growth failed to offset concerns over rising energy costs. David Bellinger of Mizuho with an outperform rating on the shares and a 137 price target. David joins us now for more. David, good morning. Good to see you.
Hey, great. Thanks for having me on.
Stock's down about 2%. Earnings call is underway. This phrase came up, investing in price. We've been talking about that. Are they struggling to pass it on, or is this just a fight for market share?
Yeah, I think it's the fight for market share. So very inline quarter. It seems like inline isn't enough these days, especially as you have more of this consumer pressure building. The tax refund payments have basically fizzled out. I mean, those are up 18% year over year. And now you've also got consumers going straight into the teeth of these $4.50, potentially $5 gas prices. Walmart's seeing that, I think, in their business, incremental pressures on the low end, but they're also seeing it on the cost side. And that's what hit them today. Talked about 250 basis points that was shaved off of operating income dollar growth because of higher fuel costs. But I think what's concerning investors today is that that's only a partial period impact for Q1. So the full force hasn't hit in Q2, Q3, and Q4. So we'll see what's to come and if prices have to move up across the space. But Walmart is making a very pinpoint move, very decided move to keep prices down as much as possible, as long as possible. And this is a share gain story.
Are they in the strongest position to do it? Versus, say, a Kroger versus a Target? Are they in the best position to do this?
Yes, I would say absolutely. Did you think about the alternative and accretive business lines Walmart has? Advertising, marketplace. These are really high margin, great businesses. Those are a source of funds to invest. Think of those as Walmart's AWS. Like Amazon has AWS to go after retail pricing, take all this share. Walmart has elements of that. Others in retail, they don't really have that cookie jar to dip into, that bucket. So Walmart is better positioned than most, and that's why we still like this name.
Walmart's investing heavily in artificial intelligence. They've been talking about how they're trying to transmit it to each one of their associates, as they call them, their employees. I'm looking right now at the number of employees at Walmart. It's gone from 2.3 million to 2.1 million and sort of stayed at that level. Is that a positive for the stock in the sense that they are investing more in AI and seeing where they can get efficiencies elsewhere?
For sure, for sure. We don't expect headcount cuts at Walmart. It's more of keep this employee count pretty stable, and then you could grow incremental revenues off of that. So a more powerful flow through, a more powerful earnings model. But they're talking about the business being very people-led, but tech-powered. So it's more of an amplifier for their employee base as opposed to cuts or anything like that. But it should have cost savings throughout the business. And then we've done a lot of work around agentic commerce, which is extremely, extremely early days. But that could put Walmart up at the top of the list. Again, more of this share gain, especially if they have lowest price, fastest speed. That's what this agentic shopping will prioritize. And we think Walmart's in a good spot from that perspective as well.
So bear with me, but a lot of places are talking about the idea of keeping their staff the same, maybe shrinking just a little bit, and then gaining a significant amount of market share. Where are they taking the market share from? Who's losing on the other side of this as they do more with less?
Yeah, it's a great question. So a lot of these large cap, mega retailers, Walmart, Amazon, Costco, they've been gaining share, especially in the grocery category is one that gives you that frequency of purchase. You get add-ons into other categories, but it's a lot of these, smaller retailers, not as much investment over the last several years. And then a lot of these private guys, mom and pop type stores. That's where they don't have the capability to invest to do such expedited delivery. Look at Walmart today. Store orders up about 50% fulfilled from the store. A lot of that is done within 3 hours or less. A lot of them 1 hour or less. And Walmart's even doing 30-minute deliveries. So if you have that capability, you're definitely gaining share. It's expensive, takes a long time to build. You'll get hit with higher fuel cost in the process. But at the end of the day, it seems like a net winning strategy that you get all this share accumulated and it's pretty sticky.
Stock is down by 2% so far this morning. David, good to see you. Thanks for being here. David Bellinger there of Mizuho on Walmart and the fight for market share in the retail space this morning. And that fight is picking up with Kroger in the mix as well.
Yeah, Kroger's trying to hang on by cutting prices potentially in order to compete with Walmart. Walmart right now is saying we'd rather miss or be sort of slightly off or in line and continue to gain market share. Again, this is the rearranging of our understanding of what retail looks like going forward, especially because some places just do not have the capabilities to keep up.
To that exact point, David was talking about it. They've got the business model to do it. The Amazons of this world have got the business model to do it. The other companies probably don't have the business model to do it. Walmart down in the pre-market, negative by about 2%. Up next on the programme, we'll get you some jobless claims data. That drops in just a moment. We'll get reaction from Barbara Reinhard at Voya Investment Management. Live from New York City this morning. Good morning. Equities declining by 0.4% on the S&P. Bond yields a bit higher, up by 5 basis points on twos. And in the commodity market, crude up by close to 3%. WTI at 101, Brent at 107. Equity futures on the S&P down here by a third of 1%. On the Nasdaq, we're negative by 0.5. In the bond market, yields climbing, going into jobless claims, up by 5 basis points now. On twos, the sell-off in fixed income resumes north of 460. On tens again, up by 3 basis points on the session. The initial catalyst for some of this price action was earlier this morning in the commodity market. Brent and WTI creeping higher. WTI up by 3%, Brent crude up by 2.3 to 107. Some tension in the negotiations in the Middle East. That's the cross-asset price action. Let's get you some data. Mike McKee has the latest. Morning, Mike.
Good morning, John. Everybody keeping an eye on jobless claims. Isn't going to get a whole lot of information. No change almost. 209,000. Last week, revised to 12. So we're really not seeing many changes there. And the continuing claims number, 1,782,000, just up a little bit from 1,776 the week before. The interesting thing is Bloomberg Economics has a piece out that suggests that maybe jobless claims are being distorted by efforts by states to cut down on fraud, and that's why we're not getting a comparative rise in jobless claims, but we'll just have to keep an eye on that. Philadelphia Fed is out, and the Philly Fed number goes to negative 0.04 from 26.7, a big drop. Prices paid at 47.9. That is down from 59.3, surprisingly. And prices received at 26.3. That's down from 33.5. So a little bit of an odd number there in terms of the pricing numbers. And housing starts come in at 1,465,000, down from 1,507,000. That's a 2.8% drop. Building permits up by 5.8%. We'll see if that translates into actually anything. What people are really going to be watching, guys, is a little bit later this morning we get the S&P Global U.S. Manufacturing, PMI, Services, and Composite. Those will be the preliminary numbers for May, and we saw downturns in Europe when those numbers came out as the war starts to take a turn on the economies, and we'll see if we get that same result here.
They've had a rough run when it comes to the PMIs over on the continent. Mike, thank you for that. Every single time we get jobless claims drop. Tumbleweed. No story here whatsoever. Nothing to talk about. Everything's okay, apparently.
I mean, to me, it's flatlining, right? Which is the reason why people are thinking, is this thing still on? Everything okay over there? Is this actually a signal in any way? If it is a signal, it's being taken as things really are not deteriorating materially in the labor market, which checks out with some of the spending data and some of the other labor market metrics. And the response then is maybe not only are we at neutral, but potentially the Fed could have to hike. I was looking at the warp function, looking at Fed funds rates, the expectation for any kind of rate hikes or cuts. We're now almost pricing in a full rate hike by December. Just giving you a sense of how much we're pulling forward those expectations.
Let's talk about the deterioration in the bond market this morning. Bonds down, yields up 5 basis points higher on twos to 4.1% on a 10-year this morning, still higher by 3 or 4 basis points, back above 460, 462 this morning. Barbara Reinhard of Voya Investment Management writing, the AI boom will come to an end, but we think it's too soon to call the end. What worries us, it's the bond market. Barbara joins us now for more. Barbara, good morning.
Good morning.
What worries you about the bond market this morning?
Well, the backup in rates is somewhat concerning for the equity market, which is why the equity market has come under, a little bit of pressure over the past couple of weeks as bond yields have been rising. There's always a continuum and a place where bond yields rise high enough that PE multiples start to contract. And that's kind of the scenario that you saw in 2022. We don't think that we're there. We think that the inflation surprises that we've seen have really all been supply driven by the price of oil, not demand driven like it was in 2022 when there was a lot of money in circulation and consumers had a lot of pent up demand. But we do note, in order to get the price of oil sustainably down, you need to see some resolution in the Middle East.
Back to square one all over again. We've got no idea when we get any kind of solution to the situation in the Middle East. So energy creeps higher, just a little bit more. Again this morning, yields creep higher as well. Going to ask the Lisa question. Lisa's asked it a million times. At some point, that bond market becomes a problem. Where is that point?
Oh, that's a tough question to ask. 5% was the big problem in 2022 on the U.S. Treasury 10-year. We're inching up. It's also been the speed of the increase in bond yields that causes the problem, too. So it's really twofold, not only the exact level, but the speed of the increase. And this has been a fast rise in bond yields. But I would note the fundamental change at the margin on the news out of the Middle East seems to be inching towards a resolution. Every time you hear a little bit of good news on a resolution, oil prices come down below 100. That tends to help the bond market and certainly helps the equity market like you saw yesterday. But Lisa, you pointed out, the fundamental data in the U.S. is relatively strong. And, part of it is that the U.S. has much more energy independence and also is a more efficient consumer of oil, which makes it the effect of higher oil prices a little bit less in the U.S. than it is, say, in the rest of the world, specifically in Europe.
Do you think that the earnings that we're seeing in big tech are incompatible with the strength in earnings that we're seeing in some of the other companies that are seeing pressures from some of the cycle, based on whether it's oil prices or whether it's pockets of weakness in the consumer?
Well, you have to look at sales growth, and sales growth for 1Q looks like it's up 10%. So this is not operating margins just expanding. This is actual underlying sales growth. So the demand story looks to be pretty solid to us. Of course, the longer that this conflict in the Middle East continues, the more it starts to weigh on sentiment, the more it continues to somewhat cloud the outlook. But you didn't see that in 1Q earnings, so I think we're on a clear side for just a while longer.
Do you think that people are looking for a bearish side? I mean, do you think that people are looking for a reason to feel bad and they say, oh, it's the bond market, which is what we just heard from Lori Calvasina, but then she looks at the earnings and she's like, I can't find anything.
Right. So I think there's two things going on. So we've looked at this at Voya in great detail. You've had two big secular bear markets in 2000 through 2003 and then 07 through 09. Those were bigger than 50% declines in equities. It takes an average of 25 years for an investor to forget a secular bear market like that. So we're just at the point where we're getting past the scars of the TMT bubble in 2000. So I think this little bearish tilt that you see into the market, this kind of always calling for the end is nigh, is likely to be with us for a while just because of that behavioral finance segment that we've been so scarred, not once, but twice in a 10-year time period, and we're not that far away from it.
Did that feel personal? Well, I just saw you starting to laugh. Starting to laugh, and it just felt,
you know what I was laughing?
Go on.
I was laughing about the Homer Simpson, the end is nigh, ringing the bell with the thing. I mean, I was just thinking, there are quite a few little Homer Simpsons running around right now.
Well, and meanwhile, I was thinking Lisa and I had this nice moment.
It was a nice moment. It was a nice moment.
This great connection that you understood.
Not a bullish connection, just in case you thought it was that. Just saw this headline. I wanted to bring it to you just briefly. So when there was this big stress, the initial energy shock, certain currencies were exposed to that. And certain central banks, certain jurisdictions had to protect their currencies, defend them. Over in Turkey, the initial conversation was about liquidating gold reserves to defend the currency. Just saw this headline cross that Turkey liquidated almost all of its US Treasury holdings back in March.
It opens a question of how much the weakness that we're seeing in treasuries right now is due to central banks selling to defend their currencies and defend their economies due to the oil price shock. Turkey liquidated, it sounds like, pretty much everything or quite a bit in order to defend its currencies. It, again, goes to the question of who will the ultimate buyer be for some of this debt. I wouldn't take Turkey as a signal for all other central banks or necessarily global dynamics. Nonetheless, again, on the margins, some of the big ballasts of the bond market are facing their own pressures and are having to actually use their cash.
The team here at Bloomberg just breaking down the numbers just to share them with you. The amount of treasuries held by Turkey fell to $1.8 billion by the end of March, down from $16 billion the previous month. So not a massive amount in the context of the overall treasury market, but real money. Barbara Reinhard of Voya Investment Management. Barbara, thank you. It's good to see you.
Thank you.
It was a beautiful moment. I shared it. I was happy to be here to witness it. Let's get you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Recapping that data we just got, jobless claims coming in at 209,000 last week. That's just lower than estimates. Continuing claims, meanwhile, coming in at 1.78 million, ticking up slightly from the previous week. Iran's supreme leader ordering that the country's near weapons-grade uranium should not be sent abroad. Reuters reporting that Iran's top officials believe sending the material outside would leave the country more vulnerable to future attacks. And crews at New York's LaGuardia Airport are working to repair a sinkhole discovered at one of the hub's two runways. The hole forced hundreds of flight disruptions Wednesday, making for a slow start to Memorial Day weekend travel. Some delays and cancellations were reported again this morning. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate it. Up next on the programme, don't miss this. The US Undersecretary for Defense, Emil, live from Washington with Annmarie in the nation's capital. That conversation just around the corner in D.C. from New York. This is Bloomberg Surveillance.
We have a very, very different strategy on AI. We've embraced at BNY AI as a superpower. AI for us means growth and opportunity. The rationalization over the last couple of years, we've largely dealt with through attrition. That's taken excess capacity out of the firm in a more strategic way, which I think our employees are very pleased to see.
A very different approach from the BNY CFO. That was Dermot McDonogh on the programme a little bit earlier. That stock has had a fantastic run, trading under BNY as of today. Equity futures right now, the S&P pulling back by 1/3 on the S&P. On the Nasdaq, we're down by 0.5%. Tech in focus, and tensions between the Pentagon and AI giant Anthropic remaining still quite high. A federal court signalling it may uphold the DOD's push to designate the company as a supply chain risk. Annmarie is in Washington with a special guest. Hey, Annmarie.
Hey, Jonathan, good morning. AI is not just dominating Wall Street, it's also dominating the conversations here in Washington, especially when it comes to the U.S. industrial complex. And an individual that's in the middle of this fight with Anthropic has been the Pentagon's Undersecretary of Research and Engineering, Emil. Michael, thank you so much for joining us.
Good to be here.
The last time I spoke to you actually was after this fight really brewed out into the public, and you had called the Anthropic CEO as having a God complex. Now it seems like this federal appeals court kind of agrees with the DOD. So if this stands, is the Pentagon truly ready to not use Anthropic and its models?
Yeah, well, when they were declared a supply chain risk, they took that to court, not us. We were ready to start a 6-month transition out of their using their services. And by the way, there's a lot of other companies that are very willing and able and excited about serving us, because we just signed deals with Microsoft, OpenAI, SpaceX, NVIDIA. So we've got great other partners there.
Has the conversation stopped with Anthropic, or have you been in touch with them?
Conversations stop when you sue someone. You usually stop talking.
How awkward, though, is it, though? Because Dario Amodei was recently at the White House having a meeting with Susie Wiles, and other parts of the government are using Mythos.
Yeah, well, the way I put Mythos is in a category with other cyber models. Some of these models are becoming very effective at cyber capabilities. And what I mean by that, helping you find vulnerabilities in your own code. That could mean that you could use it for defensive purposes to harden your network. It also means that a bad actor could use it for offensive purposes to hack code. So we have to, as a government, treat all these new capabilities in a different way than we've ever treated anything like this before, to make sure our networks are patched, our community hospitals are protected, our utilities, everything that uses software and technology. So you'll see us as a U.S. government looking at all these models and working with them.
You're seeing everything right now. Is there anything that is up to the same level as Anthropic?
Yes, and I'll tell you why. Part of the reason these models are good at cyber is because of the coding revolution. All these AI models help you code. That code helps you train the next model on what good and bad code looks like. So if you recall that Claude Code was first out of the gate, but then OpenAI launched Codex, and then Elon Musk at SpaceX AI will have something similar, and those models will naturally evolve to be good at code. So I'm talking about every month or two, you will see another drop of a model that has similar capabilities.
So just to be clear, though, even though the DOD and you're describing it as supply chain risk, it is okay for other parts of the government you think safe to use it. What if it was like a Huawei that was described as supply chain risk? Should Treasury or Commerce be able to use it?
We have to remember we have a specific mission at Department of War. Our specific mission is to protect the American people and to protect our warfighters. And if the terms of service that a company gives us prevent us from doing that, for example, it says in their terms of service, we can't develop weapon systems. We can't use it for battlefield management applications. We can't use it to direct interceptions from an incoming drone or a missile attack. That's not the same thing that Commerce is worried about or HHS is worried about. So this risk is specific to the DOW and their ideology about not wanting to serve us in the way we need to be served.
You mentioned other these partners you're working with. Recently, I saw that Google, some employees wrote to the executives saying, we don't want to work with the Pentagon. We don't want this company to do this. Are you seeing pushback from AI? We're off of a weekend where the future of this country booed commencement speakers the second they mentioned the words AI or artificial intelligence.
Yeah, I think to address the Google things, I think 600 out of their 100,000 employees, or less than 1%, sort of had an issue with it. And I think they've learned from the activism of 10 years ago when employees wanted to import their political opinions into the company's strategy. And these companies are public companies. They have a lot of public shareholders. So the leadership has to do what's good for those shareholders. When it comes to, the AI reputation and where they rank for the American people, the military is here and the AI companies are down here. And it's because the leadership keep talking about job loss and loss of sort of sovereignty as an individual. And I think that's wrong. I think they should talk about what AI can do, help you maybe more efficient, help you grow your business, help you cure diseases, help you do things that it can do. And I'm encouraging all of them to talk about that piece because I don't believe the bad piece, but I do believe in the good piece.
Standard Chartered CEO said that they're replacing jobs with replacing, quote, lower value human capital with AI. Do you see your rank and file embracing AI, or are they pushing back and concerned about also jobs?
Yeah, so as the Department of War, we are embracing AI. We went from 80,000 users before we deployed AI broadly to the department to about 1.5 million out of our 3 million employees and contractors. So we're seeing great interest. And the reason is because it's making their jobs easier and it's letting them do more in less time. So I think some of these companies are using AI as an excuse to slim down the companies they already wanted to slim down, where we're using it, and we're not shrinking, to increase the productivity of employees.
I just got back with the president from China. You mentioned how Anthropic is on the same level as you're thinking OpenAI and what Elon Musk is doing in terms of XAI. Where is China right now? How close is the competition?
Well, the Chinese have historically benefited, let's say, from the IP of the American companies that have built really exquisite stuff, stolen. And the way these AI models are stolen is by what's called a distillation attack. They sort of hit the model and so on. But that only goes so far. So I think our lead over China, 6-12 months, will continue to grow because we'll be better at figuring out how to stop those attacks. And just because we have the chips, we have the knowledge, we have the researchers, and we have competition in this country. So I think we're just going to outpace them.
Emil, Michael, thank you so much for your time today.
Thanks for being here.
John, of course, that was the Undersecretary for Research at the Department of War, Emil Michael. Really interesting. 6 to 12 months, he says, we have that race when it comes to China.
Annmarie, thank you. Appreciate the update. Great work this morning down in Washington, D.C. More from Annmarie through the next 24 hours or so. Remember, tomorrow, the main event really for us here in financial markets, particularly the Treasury market and interest rates. Kevin Walsh getting sworn in at the White House to be the next Fed chair. When I was listening to Emil there about the Defense Department, we're not shrinking. I was like, yeah, no sign of you guys shrinking anytime soon, given the risks on the horizon and the push to get a bigger budget down in Washington.
Yeah, and to finance all of the conflicts that have been brewing, especially given the pace of technological change that they've got to shift over into the Defense Department.
What a massive year we've got ahead of us. We could see not one, not two, but three of the biggest IPOs we have ever seen in the history of financial markets. Ed Ludlow is going to be tracking the story for us on Bloomberg Technology, and Ed joins us now for more. Ed, welcome to the programme, buddy. What are you hearing about SpaceX, about OpenAI, and how long do we have to wait before we see Anthropic?
Yeah, a wild 24 hours. The SpaceX imminency is probably the biggest story, right? And, it was fascinating to go through the S1 with a fine-tooth comb, understand the debt implications, the exposure markets already have to SpaceX. The banks that are lead left or not lead left doesn't really matter. But the timing of the reporting that OpenAI is also thinking about filing as soon as Friday or in the coming weeks is interesting. And, when you phone up investors in an environment like this, you're trying to understand the SpaceX S1 or a world where you would have a SpaceX IPO in June or July and then OpenAI in September, Anthropic in October. There's not infinite liquidity in a market like this. The banks are all working on the same deal, but think about the kind of crossover and cornerstone investors that you'd want on board. And so that's been fascinating. But, SpaceX has gone out the gate quickest and will try to do the biggest IPO of all time.
Ed, these are all really smart people who are chewing the finances at these companies. Are they trying to rush to get in during the peak valuation moment?
Yeah, I mean, the story I always come back to and could not be more apparent from the SpaceX S1 is why would SpaceX even want to go public, knowing the context that Elon Musk is not a fan of public market governance. They need the capital, and the mechanism of the IPO, even though private markets have been absolutely willing to do very, very high rounds, they need that money to fund the business plan. You know, if you're going to raise $75 billion, it's for a reason. And for SpaceX, it's as simple as buying the GPUs for their data centers in orbit. And the story with OpenAI and Anthropic is they are vastly compute constrained. You know, they keep arguing if we had more compute, we could do more things, show better revenue growth, and improve our finances overall. The IPO is the best mechanism for that. That's my understanding.
Ed, isn't it notable we're not talking about NVIDIA this morning? It used to be the headline act in tech, and this morning, waking up, I've mentioned tumbleweed twice now. It's just like tumbleweed going across New York. No one's really talking about it, Ed.
We just had the same debate for the show. You know, SpaceX is probably the lead, right? NVIDIA's completely flat in the pre-market. And generally speaking, the market sees it as a clean beat. But we knew that whatever the numbers in the quarter gone and the outlook for the period, it didn't really matter. You know, NVIDIA's principal argument is that their growth is tracking beyond hyperscaler capex. So they leaned on the fact that hyperscaler capex will be $1 trillion in 27, and it's on track for $4 trillion by the end of the decade, and they're growing beyond that. And they have this number, a $1 trillion backlog. It is just Blackwell-Rubin systems, and it ranges from calendar 25 to 27. But if you hit FA Go on your Bloomberg terminal and try and track what the street sees as being revenues between calendar 25 and the end of 27, we're not at 1 trillion. So there's something that's still missing here in what the market believes in the NVIDIA story, longer term, beyond the moment that we're in right now.
Ed, it's good to see you. Looking forward to the programme. Great reporting, as always. Ed Ludlow there of Bloomberg Technology, alongside Caroline Hyde, coming up in a few hours' time. When you speak to Ed and anyone in Ed's world, they talk about compute constraints, supply constraints, energy constraints. When I talk to you and people in financial markets, it's a different conversation. There are capital demands here, there and everywhere to funnel into this particular venture, this massive push to really go after this technology. And I just wonder how quickly we become capital constrained. How quickly investors start to push back.
It's a great question. A lot of the bankers are trying to get ahead of that, as Ed was talking about, given the fact that they know it's not unlimited. It also explains why some of them are trying to rush it out, right? SpaceX is first. Cerebras was a clarion sign to everybody. Let's get this going. And then, of course, OpenAI wants to be Anthropic for a lot of reasons, but also to suck up some of that demand. I will say on the NVIDIA tumbleweed point, I find this really interesting, especially given a story in the Financial Times I thought was really excellent about how much 40% of their free cash flow they are pouring into investments in the whole ecosystem. They are intimately connected to the success of all of the hyperscalers, of all of the small product investors. The investment is just massive in terms of the footprint throughout the industry. How do you gauge that? How do you sort of price out what that will ultimately mean?
Where's the opportunity? Where's the risk? It's going to be quite 6 months ahead of us going into year-end, that's for sure. Coming up tomorrow, Brian Levitt of Invesco, the NYSE president, Lynn Martin, looking forward to that, Alex Altman of Barclays, and Yelena Shuretseva of the Conference Board. From New York City this morning, good morning. Thank you very much for choosing Bloomberg TV. Have a wonderful day. We'll see you tomorrow morning. This was Bloomberg Surveillance.